Welcome to the October 2025 meeting of the Governmental Accounting Standards Advisory Council. I'm your chair, Rob Hamilton, the State Controller for the state of Oregon. And just thank you everyone for coming in. And I just got to say what wonderful accommodations we've got here. Hopefully you're really enjoying the hotel. This is such a treat. So thank you for all those that were involved in making this happen. We are going to start today with the approval of the minutes, which were provided in advance. I want to open up and see if there is any discussion on the minutes as they're presented. Seeing none, is there a motion to approve?
Motion.
Thank you, Karen. Is there a second?
Second.
Thank you, Karen. Not sure who had the first, but Elizabeth. Thank you, Elizabeth. All in favor of approving the minutes, say aye. Any opposed? All right, unanimous consent. Wonderful. So the next item on the agenda is to go around the room and we'll do our introductions. I'm going to go to the right, but if you would say your name and the organization that you represent as we go around the room. So again, my name is Rob Hamilton. I am the State Controller for the state of Oregon, and I represent the National Association of State Auditors, Comptrollers, and Treasurers.
Good morning, everybody. My name is Lisa Parker. I am on the GASB staff and I am the GASAC coordinator. Thank you for joining us here at the TWA.
Barbara Baldwin. I'm from North Carolina in the Office of State Budget Management, and I represent the National Association of State Budget Officers.
Good morning, Ricky Hatch. I'm the county clerk and auditor for Weber County in Utah, and I represent the National Association of Counties.
Good morning, I'm Jackie Reck, and I'm on the GASB.
Good morning, I'm Dean Mead. I'm a partner and the government and public sector leader at Carr, Riggs & Ingram, and I here to represent the National Federation of Municipal Analysts.
I'm Anita Kovacs. I am Vice President of Business Affairs at Pensacola State College, and I represent NACUBO, which is the National Association of College Universities Business Officers.
Good morning, Paulina Aro, GASB staff.
Good morning, Pam Dolan, GASB staff.
Good morning, Abel Palacios, Vice President of Finance with DFW Airport, representing Airports Council International.
And I'm Elizabeth Thomas. I'm a public finance attorney with Butler Snow, and I represent the National Association of Bond Lawyers.
Good morning, Darren Tarleton, representing the Healthcare Financial Management Association.
Good morning, I'm Carolyn Smith, GASB board member.
Good morning, Sean Hunstock, Controller with Snohomish County Public Utility District, representing American Public Power Association.
Good morning, I'm Sophia DiCaro from the Utah Governor's Office of Planning and Budget, representing the National Governors Association.
Carl Citroen, I'm the head of municipal credit research at Conning Investment Management. I represent the insurance industry.
Good morning, Kimmy Ellen, CEO and Managing Partner of Benford Brown & Associates, and I'm representing NABA.
Morning, Alan Skelton, Director of Research Technical Activities, GASB.
Joel Black, GASB Chair.
Good morning, I'm Karen Karaher, the Executive Director of the Ohio Public Employees Retirement System, and I'm here representing NASRA, the National Association of State Retirement Administrators.
Bill Blend, representing the National Association of State Boards of Accountancy.
Rob Weber, Vice President of Moody's Investor Service, representing the bond raiders.
Harriet Richardson, retired Inspector General from the Bay Area Rapid Transit District, and I'm representing the Association of Local Government Auditors.
Hi, Jeff Praviti, GASB Vice Chair.
Good morning, Christine Brock, Assistant City Administrator, Chief Financial Officer for the City of Franklin, Tennessee. I'm representing an International City Managers Association.
Scott Deviney, I work for the Office of the Washington State Auditor, and I'm representing AGA.
And I'm Bob Scott. I am representing Government Finance Officers Association, and I'm from Prosper, Texas, a suburb of Dallas.
Joe Wicklund, GASB staff.
James Robbins with PIMCO, Senior Associate doing credit research, representing ICI.
Good morning, Hattie Mitchell, CFO for Forest County Potawatomi out of Crandon, Wisconsin, and I'm representing NAFOA, the Native American Financial Officer Association.
David Goldman,
Deputy City Administrator and Finance Director for the City of Oak Harbor, Washington, and I'm representing the National League of Cities.
Good morning, Diane Ray, GASB member.
Good morning, Robert Scott, GASB board member.
Good morning, I'm John Lazuski. I'm the Commissioner of Finance for the City of Yonkers, representing the U.S. Conference of Mayors.
Good morning. My name is Michelle Waterworth. I'm a partner with Plant Moran, and I represent the AICPA.
Good morning. I'm Debbie Miller. I am the CFO for the Illinois State Treasurer's Office, and I'm representing the National Association of State Treasurers.
All right, thank you, everyone. Just a few more housekeeping items before we jump into the next stage of the agenda. You've all done a great job. You'll notice that the light turns red when our audio is on. You know, the FAF building, it turns green. So just a slight difference, but you all did wonderful. So keep up the good work. Also wanted to notice that this is an audio only meeting for us. So there is no video. And so you'll want to, and we've all done a good job of that, but just wanted to continue to mention that as you begin your comments, you're going to want to say your name and the organization that you represent, just like we do in our normal meetings. And as we normally do, we will raise our little tents there when we have our comments to share. And again, just really want to encourage people to share their feedback to the board and the staff. It's just it's such a unique opportunity that we do have to be able to share our perspectives for our organizations and ourselves. So just really want to lean into that opportunity. And as we've talked before, if you do agree with a previous speaker, if you can elaborate on what area that you agree, as opposed to I agree with what somebody had said before, just that gives some context to the staff about what area of agreement that you do have. I also want to make note, Suzanne Lowenson, our vice chair, she will be joining us a little bit late, so you'll see her come in hopefully real soon, but she will be joining us here in the coming time. With that, I believe I will turn it over to Joel for the report of the GASB chair.
Thanks, Rob. Welcome, everybody. I know you're really disappointed that we didn't go to beautiful Norwalk, Connecticut, which is actually very beautiful this time of year. But this is a unique place, and we're excited to be here and really thankful that you all made it. I say this every time, but it's just worth knowing that we do understand. We ask a lot of you. There's a lot of people here, and you've all done a lot to prepare, and we're really looking forward to you sharing your time, your expertise with us over the coming day and a half. It's really valuable to the board. It's valuable input. So just thank you. You're volunteering your time for us, and we really, really do appreciate and value that. In your materials, you have my second quarter report, the third quarter report we are working on. It'll be out in a bit. I'm going to, in my comments, really highlight changes since we last talked at the last meeting and I provided a report, which was in July. So the focus is really going to be more on the third quarter. The board did approve the technical plan for the final third of 2025. I was about to say 2023. I don't know where that was coming from. I'm really dated. That was the last time we were here, actually, I think. I'm still stuck.
Might be
in
true.
2020. Anyway, sorry. In the technical plan, the board made no changes. I'm going to talk about, I don't consider it a change, others might in a minute. But we continue to kind of maintain that high bar of, if we're going to undertake a project, we want it to be a significant improvement in the financial report. Those can, as I talked about back in July, come from many things, but in particular, three things. One is, information, new information, different information that users tell us that they need. And this meeting, especially the emerging issues, is one of the main places where we hear from users, not the only place, but one of the main places. So we certainly look forward to hearing if there's information you need. The external financial report makes sense as the place to receive that information. Those are the kinds of projects that we want to work on when that information is significant to your decision making. Those significant improvements can also be a gap in GAAP, as I like to call it, where maybe there's some new emerging issue like digital assets or something like that, where the current GAAP just doesn't really apply very well and you need help in applying it. But those improvements can also come from simplifications or reductions in requirements or reducing complexity, those kinds of things. So we really look forward to hearing where you think those significant improvements can come during this meeting. The one I say it wasn't a change in the tech plan, but kind of sort of some might view as a change in the tech plan, but it's certainly worth updating you on because otherwise I don't think we have it on the agenda for this meeting, is we are planning to have an implementation guide update for 2026. We released one for 2025 back in June. They've been coming kind of every other year for the last several times, but that really is about when we have the right number or an appropriate amount or significant enough comments to produce one. We feel like we already have that for this time, so we are planning a 26 update. It will focus exclusively on Statement 103, which is part of the trying to get it out where you're timely and you're implementing Statement 103. And within that, the board at least sees 6 questions, which might be the only questions. We'll debate them later this week a little bit. Let's talk about them later this week. They're all focused on subsidies. The definition of subsidies are certain things subsidies. So I guess timing wise, we'd like to get it out as soon as we can around June of 2026. It might be before, it might be after June 30. But the exposure draft is probably not going to come out until early 2026. We don't meet with you guys again until March, so you will have a chance at the March GASAC meeting to provide comments, I'm sure, on that update. But certainly we look forward to your comment letters on that when it is released to make sure that these Q&As are written in a way that they provide the clarity we hope that they do and that they are helpful to you as you implement Statement 103. So if you look at our tech plan, then we really have 5 standard setting projects. The implementation guide update is one of them. So we're left with 4 projects. You are hearing about each of those projects during this meeting over the next day and a half. So I won't really comment on there, but we do continue to make progress on all those projects and look forward to your input on the things we're recently talked about when those projects or are talking about coming up. The voluntary digital financial reporting project also is very important to us and continues. You'll get a good update on it tomorrow. So we'll look forward to your thoughts there. I think one other topic that has been of interest to this council that we don't really have on the agenda for right now, I wanted to update you on, and that's the cybersecurity risk disclosure pre-agenda research activity. In your prioritization, you rated it, tied for the highest item. We continue our work on that. The plan currently is for that research to be presented, finalized, and presented to the board at its February 2026 meeting. Then we will also present it to you in your March GASAC meeting, along with whatever a project prospectus might look like at that point in time. Is there a project? Is there not a project, et cetera? And then the board, after we hear your input in March, would be planning to consider a project prospectus after your GASAC meeting in March. So that's the timing of the cybersecurity risk research. One other thing I did want to mention that we're working on that's not really on the tech plan anywhere, but I think it's important. I think I have mentioned it at these meetings previously, but that's education is a big part of our mission. And we wanted to kind of modernize the user guide in particular for elected officials, or at least reach elected officials in a different way to help them understand the importance of and understand, period, the government financial report. And so we are producing a series of short videos that Tammy Waymeyer, our senior research manager, is leading that effort to produce those along with other team members. It'll be a series of 15 or so videos, each 10 minutes or so in length, each focused on a different part of the financial report. So, elected official could just see a video about the government-wide financial statements, and it wouldn't be kind of just a talking head. It would be an actual example financial statement pulled up on the screen, and Tammy circling things or highlighting things and talking about, hey, as an elected official, this is what this statement's trying to tell you. This is how you might use it, that sort of thing. And it would fully, if you went through all 15 or so videos, you would get through the whole financial report, or you could focus on certain aspects as an elected official. We are really looking forward to those being beneficial to our stakeholders. Our plan is to finish them by the end of the year, but we don't want to really release them necessarily at December. So our plan is probably in January, February, like elected officials' New Year's resolutions. Like, I'm going to get excited about the financial report or whatever. So January and February is when we plan to release them. We certainly would love for your organizations to help us promote those videos if you watch them and believe that they're useful for your members. We're excited about them and looking forward to them coming out. So the last thing, we'll do our prioritization with you next at the first meeting of 26, but in March. But the prioritization is important to us. It tells us what you think we should be working on. So I'd like to remind you your top 6 items for this year. Tied for first were cybersecurity risk, which I've already talked about, as in pre-agenda research, and governmental funds, which I'm going to circle back to in a second. Digital assets, which continues to be on our monitoring activity, part of our technical plan. As you're continuing to see it, love to hear from you about how prevalent or significant those things are becoming. The financial reporting entity was number 4, and then GAAP structure and the revenue and expense recognition notes were 5 and 6. Those latter 2 do continue on our pre-agenda research. We are kind of moving forward with them. In particular, I'd say the RER notes is kind of going to move along with that related project in some way, shape, or form. And GAAP structure, you will hear about actually at this meeting. So that leaves the 2 that kind of aren't on the technical plan currently are the governmental funds update and the financial reporting entity. I would just say we're continuing to think about how we approach those. When's the right timing to deal with those? When we have the right staff available to work on those. We're not forgotten. We're not working on them intentionally. We're just trying to find the right time to move forward and the right place to move forward on those 2 projects. So, Rob, with that, I'll conclude my report, but I'm more than happy to answer any questions anybody has.
Thank you, Joel. Any questions? Seeing none. Appreciate the report. As always, great content. All right, so the next item that we have on the agenda is the revenue and expense recognition. Before I turn it over to Diane Ray to introduce the topic, I just wanted to mention real quick that you have your materials in front of you through some printed materials. If you do want to join via Zoom, the ask is that you mute your computer so that the audio doesn't come through in that way as well. But I will turn it over to Diane.
Thank you, Rob. So the revenue and expense recognition model, we're working our way through 3 components: the categorization, recognition, and measurement. So just a little trip down memory lane on revenue recognition and expense recognition. At a high level, we started with categorization. With category A transactions having performance obligations and category B being all other transactions, we developed the details around determining these categorizations. And I'm sure you all remember all of those discussions that we had. We then moved on to recognition and the transfer of control of distinct goods and services for category A transactions. So we worked through all of the details of that. And now this brings us to the last component, which is measurement. And so for that, I'm going to turn it over to Pam.
Thank you, Diane. As you mentioned, the team is excited to hear your thoughts about measurement. We haven't talked to the group yet about that. So I'm going to turn it over to Paulina, who's going to lead us through that.
Thank you. Good morning, everyone. So I don't know if you managed to join Zoom or wanted to follow the printed version. If you need a printed version, please raise your hand and I'm sure we will be able to hand you down anything that you may need. No? Okay. So if everybody's ready, I'm going to share and I will be calling out the slides as we go along just to make sure. But right now they should be in your screen as a digital version, just in case. So as Diane and Pam mentioned, we have gone through a very long process of working through organizing our transactions, figuring out how to recognize them with the idea of it's been worked through the accrual basis of accounting and the economic resource measurement focus. And then you get to the very last piece of the model, measurement. So we're in slide number 2. And the importance of measurement is we have spent an inordinate amount of time organizing transactions to be able to determine what is the appropriate time in which you recognize them, the time in which they meet the definition of an element of financial statements, and which element is the appropriate recognition element. But if we go back to this and we go, oh, but we cannot measure it. We cannot estimate. We cannot do the amount component of it. And we wait until we recognize them when the cash arrives. Then we just threw away about 3 or 4 years of work, because then you're reverting back to cash basis of accounting. So the critical importance of measurement is to be able to accompany recognition and be able to complement all the proposals and all the work that the board has done thus far. And so as we go through, we're going to be talking to you about the overview of the measurement methodology, which is applicable to the entire model. We're going to be talking to you about components of consideration, what makes up measurement. We're going to talk to you about fixed and variable consideration, significant financing component, consideration payable to the customer, and those are not all the bits. There's still a lot of other pieces of measurement that we have not developed, and obviously we'll be working hopefully until May of next year, and we would have completed measurement. But we wanted to give you a brief, broad overview of where we are and we have gone through. As Pam and Diane indicated, you have seen the entire recognition methodology, the entire classification methodology. Now is the point in which you need to put an amount to the elements of financial statements that you would have determined. And so from a measurement methodologies, this is probably the most conceptual and high level of the issues that we're going to be discussing. And I'm going to try to explain the principles that go along with it and then try to help you understand how they relate to the practical world. So a measurement is a component of recognition. I mentioned to you, we have spent an inordinate amount of time discussing when a transaction gives rise to an element of financial statements. Therefore, that's the point in time in which it should be incorporated in those financial statements. But if measurement fails, then the timing of recognition also goes off. That's the principle. Measurement is a component of recognition. Therefore, the board has tentatively decided that estimates must be developed to the extent that they're practicable. And the practicability is a very important issue. A lot of people today in current practice, this is not a new principle. This is not anything new that is not in GAAP. This is in GAAP today, but what we see is in practice, we say measurement has to be reliable, and the reliability gets us to, we want a lot of precision, and therefore we wait until the cash goes through, and then we go around doing what I just mentioned, not following the accrual accounting. And so the board decided to put as a tentative decision of this project that measurement estimates would be required to the extent practicable, okay? What happens if it's not practicable, which is near impossible to do? Then the proposal is that those transactions would have to be disclosed. Again, another provision that exists in Statement 33 today. Lastly, as we were putting together the initial set of proposals for the board, there was a lot of discussion of whether the measurement proposals needed to be different for Category A and Category B transactions. And the board tentatively decided that all these principles that we're going to talk about in this few slides are applicable to everything. It doesn't matter whether you have a transaction with performance obligations or a transaction without performance obligations. You need to estimate, you need to determine what to do with fixed consideration, with variable consideration, with discounts, with rebates. All of it come into the estimation and methodology of the project. There are certain types of items, and we will see an example towards the end of the presentation, that are not applicable to either A or B, and in those cases, the board will highlight in the proposals. So with regards to measurement uncertainty and estimation, we call measurement uncertainty when you're not quite sure. So you have an amount, you enter into a binding arrangement, but you're not quite sure what the amount is going to look like. That's when estimation is required to the extent practicable. Estimation in the current guidance is based on reliability. And I mentioned the reliability estimation issue has turned into an issue of precision. So the board, to be able to balance the precision issue, has tentatively proposed that it should be reflective of the 6 qualitative characteristics of financial information: comparable, consistent, among them timeliness. So if you delay measurement, you're creating a timeliness problem in your financial statements. And so by not only rely on reliability, but on all the 6 qualitative characteristics, hopefully it will create a more balanced perspective about how to develop estimates, not with only the perspective of precision. Furthermore, transactions that are not recognized in year one because it's not practicable to remeasure, you don't get to wait until the cash comes. Every financial reporting period, you should also be reassessing to determine if you have sufficient information to estimate. And lastly, when you finally get to recognize the transaction, there was a question posed that if something wasn't measurable in year one, but you have sufficient information to measure in year 2 or 3, would that be a defer inflow, defer outflow, or would that be revenue and expense? And the conclusion is that the measurability issue does not affect deferrals or revenue. If the conclusion was revenue in year 1, it should be revenue in year 3. It was just a delay of measurement. So it was just a timing problem, not a deferral problem. And so those were the very large, pervasive things that the board wanted to highlight in this phase of the project. Estimation, not solely based on reliability, but on the 6 qualitative characteristics, and then what to do when it's not measurement. In slide 6, the other aspect of the conceptual framework that the board looked at it is, and I think we have talked about since the inception of the project, in current practice today, we tend to focus on revenues and expenses. We want to recognize revenue, we want to measure revenue. While concept statement 6 tells us that you measure assets and liabilities, and then revenues and expenses are the result of those measurements. And so the board decided that similar to the recognition process where it was focused on the receivable and the payable, the measurement is also based on the receivable and the payable, and therefore the recognition of revenue is associated with the receivables and the payables. Those are essentially the basic foundational principles of the measurement methodology. Like I said, this is very conceptual in nature, but has a lot of practical consequences. The primary issue is estimation. In the next slides, we're going to start talking a little bit more tactical issues. But before that, I wanted to let Pam pose the first discussion question.
So the first question has a bunch of bullet points. So I'm just going to read through the bullet points. And when you are responding, feel free to give us feedback on all or part of those bullet points, whatever you wish. So do you agree with the board's tentative decisions regarding measurement principles as follows, and why? The first one, measurement is a criterion for recognition. Next, measurement estimates are required to be developed to the extent practicable and should be representative of the 6 qualitative characteristics of financial information as provided in concept statement 1. Measurement proposals are applicable to category A and B transactions unless otherwise noted. Note disclosures for transactions that are not recognized due to the impracticability of measurement estimates should be assessed for essentiality. And last, the focus of measurement is on assets and liabilities. Therefore, the focus is on receivables and payables, respectively.
Feedback for Pam and Paulina. Scott.
Scott Deviney, AGA. Yeah, in short, I agree. Appreciate using the unit of account term and concept. I remember that from, I remember that term from investments. I agree that measurement's a component of recognition for both category A and B. I mean, if you can't reasonably measure it, then, it shouldn't be recognized yet. I think it's both a cost consideration as well as a reliability consideration. Sometimes the information is just not available. And in that case, I think disclosure is the right solution. We have that for a lot of other things throughout standards. To the extent practicable, that made sense to our group. A point of feedback, people noticed that new criterion of reflective of the 6 qualitative characteristics. I don't think that those words conveyed what you're intending to convey. I think they were just like, oh, what's that? So I think if you are planning on adding that in, we would hope that it really gets explained and maybe is not attached just to like a revenue thing. I mean, because there's estimates throughout standards. So hopefully it can be a more general provision. Thank you.
Michelle.
Michelle Waterworth, AICPA. Yeah, we generally agreed with all of the different bullets within question number one. One comment or maybe question or observation in terms of the second bullet that requires management estimates to be developed to the extent practicable. Certainly agree with the concepts. We were trying to think where in today's environment estimates aren't being developed that perhaps would then be developed or need to be developed under this criteria, and couldn't come up with one, but that was, I love your face there, Paulina. Maybe we should talk later. That's all. Thank you.
Dean?
Dean Mead, NFMA. I think these generally made sense to us. Some of the observations we have with respect to the second bullet and the fourth bullet are that they're both rooted in the existing concept statement, so it's not clear that they necessarily need to be explicitly stated. There shouldn't be any information in the financial reports that don't possess, I think maybe is a better word, Scott, than represent the six qualitative characteristics to some degree or another. The one that confused us a little bit more, again, it's rooted in concept statement 7, assessing note disclosures for essentiality, which ought to take place for any note disclosure. But we were wondering when it would not be essential to provide a disclosure when a government concludes that it's not practicable for them to estimate an amount that ordinarily would be reported in the financial statements. So we kind of felt like if the standards say you should have a number and they conclude they can't come up with one, we couldn't think of any circumstances under which they shouldn't be telling us that they had this transaction, but they couldn't come up with a number and to explain why.
Ricky?
Ricky Hatch with the National Association of Counties. We generally agree with this as well. Just a couple of questions. If an entity decides not to report because it doesn't meet the criteria for measurement and we don't feel it needs to be reported, but later it becomes measurable, just want to make sure that the entity does not have to then go back and restate something in the prior period or treat it like some adjustment or an error.
No, agree. To the extent that it's not practicable, you don't have restatements. But if a government had the information and chose not to, then that's an error correction. So the facts and circumstances are very nuanced. But the way we're proposing is if in year one it's not practicable to remeasure, year two is practicable, it's just recognition. There's no restatement.
Very good. Thank you. Yes. Then the other question I had, and it's probably just, I just don't understand this. The documents talked about focusing on the most liquid transaction, and then it talked about receivables and payables. And I thought, is there ever an instance where you actually have something that's more liquid, a cash receipt or something like that? And if so, I'm assuming that would take precedence because that's much more tangible. It's not an estimate. So just wanted to double check with that, and that's all my questions.
Sure. So towards the very end of the presentation, one of the bubbles, the very slide, which we'll talk about again, talks about measurement of non-monetary consideration. And so that's when the fun begins about the liquidity. So we'll get there. We'll talk to you in March about it. But that's a little bit where it comes from.
Karen?
Yeah, thanks. We generally agree with everything in here. We did have a couple comments to share, though. Just one is of the criteria, we did feel reliability was the most important one. It had a greater weight than probably the 5 other remaining ones. We also had some discussion about the cost to obtain information. So even if you are able to provide an estimate, if it's extremely costly to try to get that, I mean, we wanted to, again, have a little bit of sense of reasonableness as far as using best reasonable methods with some cost considerations included. And then the other thing we talked about with respect to this, if I can move my screen down, was again, some of the same things that Dean said with the note disclosure and things. We agreed with substantiality being a component of that.
What I can tell you about the cost issue is that it gets discussed under the umbrella of practicability. So if it's near impossible for you to get the information or nearly extremely too expensive, the practicability, we have had several pronouncements and we have several bases of conclusions where it discuss what practicable means. And so that material would be carried forward to ensure that it's explained how to work through that.
David?
Yeah, David Goldman, National League of Cities. We agree with some of the concerns that were expressed by other members regarding the qualitative characteristic portion of the instructions. It might just be a little bit confusing for some financial preparers to determine exactly what those are. If those are just the general type of characteristics that have to be, in every financial report, then it might not necessarily be needed called out here if it's already something that folks are expected to be utilizing anyway.
So Rob Hamilton, NASDAQ, our group was supportive as well. We similarly, like David commented, we were not used to always thinking about the 6 qualitative characteristics. And so that was a little bit of a shift, but otherwise generally supportive. All right, back to you.
Thank you. So the next slide, it's an interesting conversation because what the discussion of the staff with the board was, now you have this very basic foundational principles of estimation and the relationship between measurement and recognition. The way that the methodology, primarily in FASB topic 606 works, is that you determine the total amount of consideration in a contract, and then you allocate it down. But we thought if we propose to the board this at this point where they really don't know how that is going to work, seems like a little bit of a difficult conversation. So what we explained to the board is what we thought the methodology would look like and asked for feedback with the idea that the allocation methodology would be decided by the board at the end of the declaration of measurement. So when they have clarity of all the components of consideration, how the allocation would work, what basis of the allocation would look like. So in a nutshell, when a government enters into a binding arrangement, there's normally terms and conditions for payment. So you have to assess all the terms and conditions of payment and determine what is the total consideration amount in that binding arrangement. You also have to determine whether you have 1 transaction, 2 transactions, or 3 transactions. You allocate to every transaction. And then if you have transactions with performance obligations, you allocate to each performance obligation. That's in a nutshell the allocation methodology. Total binding arrangement amount, allocate to transactions, allocate to unit of account or performance obligation. And then from that perspective, you have a means or a way to estimation. So the proposals of the board are not, estimate and go on your own, figuring out how to estimate. But there's a methodology that is being proposed and being developed to be able to give governments a tool to be able to develop those estimates. So as I mentioned, this is not a tentative decision of the board yet, but we thought it was important to raise awareness to understand what is the methodology and how it would work and solicit your feedback. So I will turn it on to Pam for the question.
The question is, question 2, what feedback do you have about the allocated transaction amount approach?
Feedback. Michelle?
I think this makes a lot of sense. So we're supportive. Anecdotally, this past week, I was working through 3 very significant complex transactions. And without knowing it, I did this. So good job. Makes sense to me.
Scott?
Scott Deviney, AGA. Yeah, I guess the only feedback, since there's not a tentative decision yet, is just hoping that the recognition will follow kind of what we got for leases and SPIDAs, where variable consideration for future performance is not recognized until it actually happens. Thanks.
Karen?
Karen Karaher, Nazra. We agreed with this. We wanted to basically especially compliment, we think the more flexibility, the better, given the wide variety of contracts that are and the terms that are available.
All right, back to you, Pauline.
Thank you. So now we're going to get to the little more tactical pieces. So I mentioned to you that the allocation methodology is essentially putting all the terms of conditions of the binding arrangement and determining what's the total transaction amount. And it's comprised of multiple components: fixed consideration, variable consideration, financing component, non-monetary consideration, and consideration payable to the customer. This is the structure the FASB Topic 606 uses. And what we have been doing is essentially taking each one of those chunks and working it through the governmental environment. How does it work for the government? How does it work in the context of this transaction? What are the examples of each one of these components? So we're going to walk you through the fixed and variable consideration discussion with a few examples and what are the tentative decisions of the board. And then we're going to talk through financing component and consideration payable to the customer. There's still a few bits, like I mentioned, non-material consideration is still coming, contingent consideration, constraints, collectability, a few topics still in the future. But as you can see, measurement is not just a simple, straightforward, what is the amount, but you can begin to see that there are multiple pieces when you're thinking about estimation and measurement. So the first issue was differentiating between what is fixed and variable consideration. And so we have, the board has tentatively decided that fixed consideration is that has no uncertainty. You are not wondering what is it going to be the total amount. You enter into a contract and you agree that you're going to pay $10,000 for the service. That's fixed consideration. You're not wondering. You enter into a contract and you're going to pay $100 an hour, but you don't know how many hours you're going to consume. That's variable consideration. You're not quite sure. So when you're not quite sure, that is called uncertainty. And that's identified as variable consideration. Variable consideration can be in an additive form, $10 per hour of service, or it can be reducive. I'm going to provide you a 10% discount if you buy a number of units. So this idea of variability is any circumstance that puts you in a situation of, I'm not quite sure what the amount of the contract is. That's as simple as it can come up for the difference. And so the board has tentatively made a decision to create that distinction. Fixed consideration does not create uncertainty. Variable consideration creates uncertainty. I'm not quite sure what the amount is. So we put an example between fixed and variable consideration regarding unit price, because I think is one of the issues where people get tripped up quite a bit. Like I mentioned, let's say that you have a contract with $100 per unit hour. And the binding arrangement is very explicit that you're going to consume 500 hours of work. That's fixed consideration. You don't have any uncertainty. You don't have anything to be asking, oh, I'm not quite sure how am I going to pay. You know exactly how much you're going to pay in the binding arrangement. In the second example, you have a unit price of $20 per rock of salt, but you haven't specified how much you're going to consume. That's variable consideration because you're not quite sure. So unit price in on itself does not create fixed or variable. Is all the terms and conditions of the binding arrangement informs whether you have fixed or variable consideration. Bless you. Examples of fixed consideration. For example, a state charges its citizens $50 per driver's license. You have no questions, comments, concerns, confessions. You go to apply for your business licenses, it's $50. A state charges $15 for interstate park. There's nothing unknown in there. A city charges $80 for fine for parking in front of a fire hydrant. The examples in here, as you note, are category A and category B transactions. What is therefore the variable consideration concern? Is that it creates a measurement uncertainty, because if you enter into a binding arrangement for $10, $30 per ton of rock salt, but you don't know how many tons are you going to consume, then how much is your contract really, how much are you entering into that contract for? You develop estimates. And you develop estimates to be able to forecast and measure what it looks like, but you only recognize the number of units consumed. And so the idea is to be able to work through the allocation components if you have complex transactions. Variable consideration can be, like I mentioned, additive or deductive. Unit prices are additive. The components that reduce in variable consideration are things like discounts. For example, if you have a property tax transaction and somebody files a payment in protest, you may owe them a refund. That creates variability because now I'm not quite sure how much the property tax looks like because somebody's going to come back and get a refund. Examples of variable consideration in Category A and Category B transactions. In a Category B transactions, our example relates to sales tax. A government generally imposes a sales tax rate, but you have a lot of uncertainty on the total amount by month or by year because you don't know the underlying sales. What does that mean? Estimation. In a Category A revenue transaction, we've talked a couple of examples. So a government is operating a toll road system and is charging, my window is on top of that, sorry, 15 cents per mile. And so it's going to depend, the amount of toll fees that is collected from each driver, each motorist is going to depend on the mileage that each motorist drives. So motorist A drives 50 miles and pays $7.50. Motorist B only drives 10 miles and pays $1.50. So it depends on something. Variable consideration normally depends on something happening in the future, and you're not always sure what that is going to be. So that's why it creates a little bit of uncertainty. Examples of variable consideration that reduces the total binding arrangement. I mentioned discounts. This is the typical example where in the train fares, you pay the full fares $20, but then you have military discount, veterans discount, senior citizens discount, children discount. So you reduce the amount of consideration based on specific characteristics of the population. Price concessions are examples where the discount is given to only a specific customer for a very specific reason. So they're not broad like you're just a senior citizen and therefore you automatically qualify. Credits reduce the total binding arrangement amount as a result generally of overpayment. So you went into with a service utility and overpay, they give you credit. All these kinds of things, as I noted, are variable consideration, and the board has tentatively decided that they need to be estimated to be able to determine the total binding arrangement amount. Other examples of binding arrangement that reduce the amount of consideration. I mentioned the public transportation when you have discounts for students, citizens, or veterans. An example is also a government can sell a parcel of land to a business. That would be a price concession, is specifically to this purchaser, and the price is reduced because it's expected that the purchaser of the land is going to use for economic development. So that's a price concession. And the city-owned utility is the example for the overpayment of services. So with all that, I'm going to pause for Pam to pose questions 3 through 5.
All right, question 3. Do you agree with the board's tentative decisions to describe the difference between fixed and variable consideration based on the effects of each component on measurement uncertainty, and why?
Feedback? Dean?
Dean Mead, NFMA. I think we were looking at this as kind of a chicken and egg thing. It wasn't clear to us that the existence of uncertainty makes something variable as opposed to something being variable inherently having uncertainty in it. So we're not convinced that that's a particularly useful distinction. And more broadly, not certain that anybody really has trouble in general telling the difference between fixed and variable consideration.
Michelle?
We are overall supportive of this, and we like how it in general aligns with the FASB standards.
Harriet?
So the concept made sense to me, but and maybe this goes more with the next question. The examples under fixed consideration, to me, didn't align with what you were saying about variables and the examples you used for variables. Because, for example, as a state charges a driver's license fee of $50. So the $50 is known, but is the number of driver's licenses known? And so those kinds of things, and the same with the next one, state charges $15 entrance fee. That part of it's known, but how many people are going to attend the state parks? So to me, your fixed considerations incorporated a variable component that brought in some uncertainty. And so that those examples weren't clear to me. If you're going to use examples, I think they need to be more straightforward, that they clearly are, both sides of it, the price and the quantity. And in these, I couldn't see that you knew the quantity.
Scott?
Scott Deviney, AGA. Yeah, I mean, made sense. Fixed, no uncertainty. Variable, uncertainty. Makes sense to us. It's nice that we're using the same terms as for leases and speedos. That was a plus. And of course, convergence, everything that Michelle said. So long as we're using it in a parallel way. Thanks.
Christine, do you still have a comment? Okay. Ricky?
Ricky Hatch with NACO, going along with Scott, or actually going maybe against what Scott was saying. I thought I thought the terms fixed and variable they just didn't sit with me quite as nicely. I wondered if maybe we could use the terms measurably certain and measurably uncertain. I realize that's 4 extra syllables, but it seems to be a clearer term than fixed and variable.
Kimmy?
Kimmy Ellen, NABA Inc. We did agree with the board's tentative decision. We thought that the terms, actually the fixed and variable term, the examples used made sense, and we would support this.
Bob?
Bob Scott, GFOA. I struggled a little bit with the concept of the fixed and variable. For example, Dallas-Fort Worth is toll road to death, and they have a logic of so much per mile. But the reality is, if you go from this toll barrier to this toll barrier, you're going to pay a fixed amount, period. And so I was kind of seeing those. I didn't really feel like the toll road example, at least in my experience, was a very good example, because for billing purposes, they've made it fixed. They have a logic for how much they charge between point A and point B, but it's fixed. I like Ricky's more looking at the uncertainty related to it than the just pure fixed and variable.
David?
So where I live, there's a pretty extensive ferry system, Washington State Ferries. And so if I show up in my car and I pay the $12.90 for the car, but I have a couple adults with me, I got to pay $3.90 per adult on top of that. So I guess that would be fixed because we know the exact price for each adult that shows up. We just don't know what kind of car is going to show up and how many people it's going to have in it. So I guess that's fixed because it's not based on per mile, although the $12.90 for the car is based on the ferry route. So like some ferry routes will be $12.90, some others will be $5, some will be $20, depending on the distance that the ferry runs and other factors that they built into it. But so I guess that'd be all fixed, even though you don't really know how much you're going to be collecting based on whoever shows up. So I guess we agree with some of the comments that were said here about how it could be a little confusing to figure out what is fixed, what's variable, and some of the other comments that say that at least if it, is like some other statements and other guidelines that are put out there, like with the SPIDAs, then it actually would be a little bit easier for people to figure out when they're booking these revenues. So
So I think one clarification that is relevant, we're not discussing how much is the total estimated revenue for all the tolls, but each individual transaction. So in David's example, because you know how much it charges you per person, you have fixed consideration, but you don't know the total monthly revenue. But the monthly revenue is not a transaction. The monthly revenue is the aggregation of multiple transactions. So what we're trying to do is do an estimation of the transaction. So when a government has to report 500 transactions in the month, that's a whole different kind of conversation that we haven't got there yet. We're still trying to walk, and I think we're trying to run. So it's an individual transaction estimation that it tells the difference between whether it's fixed or variable.
Thank you, Paulina. Darren?
From a healthcare perspective, I felt like you were describing healthcare revenue when you said complex transactions where you're not really quite sure what the amount is. So I feel like the fixed variable delineation makes sense. It seems pretty consistent with where FASB's at, which we like that. Yeah, just generally supportive. The discounts, price concessions, credits make sense. I mean, effectively all healthcare revenue is going to be variable when we get to it. One thing I'll be interested to see, I guess, is, and I don't know if this is in scope or not, but the distinction between variable consideration and when you have credit impairments or bad debt expenses, and trying to determine in a healthcare environment what is variable versus what is a bad debt.
Yes, collectibility will probably be the very last topic.
Bill?
Yeah, I'm from the NASB's position, don't really have anything, but as somebody that practices in this environment, I find it interesting because in general, I wouldn't have any objection to much of this. However, I can already hear in the room what I think you're going to see in practice with these types of standards is a lot of confusion about what you're asking to be measured and how it needs to be measured. I'm specifically somewhat concerned as it relates to the discounts and those other issues that you talked about, even going back to your simple example of a license. When you have a license that doesn't correlate with a fiscal year, are you now going to estimate the 6 months that falls in the different years and how many licenses you have and the complexity of that? We can get back to the idea of materiality always, but I don't think the preparers and the preparers specifically then get into over complexity on what probably, while we don't want to say this, should be a cash recorded transaction, right? The money that's coming in that you're getting for the ferry ride, right? What did you actually collect during that period versus, well, what is my measurement for those that are outstanding? And we can get into, you know, the discussion of sales tax and things like that. Anyway, I just think what I read, I definitely have a fear that the preparers, maybe not the sophisticated preparers, not the entities that have, you know, a strong group of CPAs that are qualified in what they do, but those simplified preparers, those inexperienced preparers.
Abel?
Abel Palacios, ACI, sorry, I'll try that again. Question concerning the variability. We've got contracts that tie to consumer price index, and that's certainly a very variable component, and that's often not known till that end of that reporting period. So I'd like to see some clarification related to some of the variability related to unknowns like CPI and how it would relate to accounting for that.
So another topic that we haven't addressed yet, but I think one of the important issues is at the fiscal, so the way the methodology works is as if you have to recognize the transaction right now, right? But generally what you do is the estimations of financial fiscal year end, and you do your true ups and then. And so therefore, by the time you know your consumer price index, you should be able to make your adjustments for fiscal year end.
That's correct.
So for accounting financial reporting purposes, we don't tell you how to book the transactions. We just walk you through the methodology as if, but then at fiscal year end, your policies and procedures can get you to there. So if Monday to, I've always teased you about every time we're working this project on Monday to Friday, you pray to the cash gods. That's not my concern. But at fiscal year end, financial reporting, in my humble opinion, ought to be accrual basis of accounting. And therefore the measurement and the estimation comes when you're closing out the books.
All right, so just to wrap it up, Rob Hamilton from GASAC. We agreed with the staff recommendation and where things are with the tentative decisions. I think it was interesting as Harriet described some of the items that she was wrestling with. I kind of found myself similar, but I appreciate the clarification. That was helpful for me, Paulina. All right, back to you, Pam.
So we have questions 4 and 5, which you've probably already largely answered, but I'll just throw them out there in case someone was holding back. Question 4 is, what observations do you have about fixed consideration? And question 5, what observations do you have about the topics discussed in variable consideration thus far?
Scott?
Scott Davini, AGA. I don't hold back, but I don't have anything meaningful to add on question 4. With question 5, agree that the concessions and credits and discounts, like those are all things that should reduce cost and can be estimated. I hope just to kind of build on some of the questions, I think the thing that our group was most concerned about was, again, hoping that the variable consideration that's based on future performance would not need to get recognized similar to leases. So to give you an example, you got multi-year binding arrangements, maybe for purchases. If it exceeds a certain threshold, maybe you have penalties, maybe you have discounts. You got shared costs between cities for like a wastewater treatment plant, and there's a certain price, but then if you exceed a volume, then you start having to pay additional. PUDs get rebates if they meet conservation targets, et cetera. And I think that the main concern was just like, so we don't have to like estimate what's going to happen in the future and then try to like match that back, because there's no matching principle, right?
Right. So let's clarify a couple of bits. When we're dealing with variable consideration, particularly the unit prices, the reasons what you get asked to estimate is not to recognize them. So you have, let's say, the 3-year cost binding arrangement where you're buying products for 3 years. But in year 1, you pay one price. In year 2, you pay a different price. You pay a third different price because you have a tier discount, right? Is that reflective of the actual cost of the goods? And so therefore you're asked to estimate, I'm going to approximately purchase 2,000 goods, average out the unit price and recognize the estimated cost, but you only recognize what you have purchased. You don't recognize anything that you haven't received or provided. Remember, the principle of a performance obligation is the recognition point is at the transfer of control of goods and services. We do not have executor or contract recognition in here. So unit price per performance would never be a recognized thing without performance. What is causing the differential that I'm not sure is clear is that whether you get to not estimate, you get to estimate, because otherwise in year 1, you're paying unit prices a lot higher than year 3.
Yeah, I think that's what everyone was worried about, was that we would have to estimate the total volume over years and then back into like, oh, here's going to be the cost and stuff. Yeah. Sorry. Our group really was hoping to avoid that. Thank you.
But then you're recognizing based on, again, we're going back to cash basis.
Yeah, I don't know if I agree with that.
Kimmy?
Kimmy Ellen, NABA Inc. My observation actually is that the understanding and accuracy will really be a factor of the experience and the sophistication of the preparer and the user.
Dean?
Dean Mead, NFMA. Paulina, in the last few minutes, you said 2 things that would have been would have made all the difference in the world, I think, for our conversations. One, the practicality of dealing with most of the stuff when you're closing out the books at the end of the year, and this is not something you're trying to figure out on the fly as the year is progressing. And even more importantly, the second one, remembering that this is not a distinct topic from the recognition and categorization parts of the model that we've already been going through, and when you do take it in that context, you know that we're not there's no expectation that this is going to result in governments trying to figure out how much rock salt they're going to use in the future and booking some kind of amount now, and which I think, when I communicate that back, I think will provide a lot of relief, because there's absolutely no interest in among our people in governments trying to estimate things that are essentially contingent upon future actions or events or performance, and very comfortable with the way it was dealt with in the leases and Sabita's standards, and would like to see that continue. That whenever there's an aspect of this, unless the transactions occurred, like with the estimation of sales taxes at the end of the year, until whatever underlying event or performance or transaction occurs, that there wouldn't be any expectation that governments would have to estimate anything.
Well, I think that that's not quite precise also. So there's an estimation need, but there's not a recognition need. So you cannot recognize something that you haven't received or provided because you haven't satisfied a performance obligation. So it doesn't go away. But what you have is circumstances in which you have a multiple year agreement with higher price in year one, middle price in year two, and then price in year three. I had an example. It was actually a former GASAC member. She's no longer here. 3-year agreement, and it was paid $1 million up front, $1 million at the end, and then there was a unit price in the middle. And the recognition was expense in year one, expense of year three of $1 million, and the unit price in between. Well, that's not reflective of the cost of the service. And so you're expected to estimate the consumption so you can have a proper reflection every year. You don't have a day one expense of $1 million. You just outflow the cash. And so if we're going back to not need to estimate, we're going back to cash basis. The estimation is needed so the allocation amounts are appropriate. But the recognition only happens when you receive or provide the goods and the services. So there's a very different thing saying estimation is avoided than saying a recognition of something you haven't received. That's not appropriate. You do not recognize things you haven't received or provided. But there's an estimation issue because otherwise the price differentials get completely shifted. I think we've talked about, did we talk about the short model at some point?
We've mentioned it at some point. I don't know that we talk about it every time.
So under the performance obligation model, there's something called a shortcut model, which is basically the invoiced amount. And we believe that the vast majority of the transactions that a government engages are going to be the invoices reflective of the units received or provided and the unit price, and you're done. That's called the short model, which is basically you recognize the revenue and expense based on an invoicing. The reasons you get to step out of that model is when you have consideration provided at the beginning, at the end, or you have discounts. So you don't have to do this allocation methodology and estimation methodology unless you have complexity in your transactions. If your transactions are simple and straightforward, like a utility does, that model likely than not will go through the invoicing approach and be done. But when you have complex interlocal agreements, or where you have multiple year purchasing contracts where you have made an upfront prepayment or have a last closeout contract payment that is very significantly and distort the cost of the goods or the services, that's when the allocation methodology and the estimation comes from. So it's not an all or none situation. In the leases and the SPIDAs, you didn't recognize future performance because it would have been an executor contract. You have neither received nor provided a services, so you did not have a day one recognition. You're not going to get recognition in here either. But the estimation of cost is important. The estimation of the transaction amount is important.
Thank you, Paulina. Ricky?
Ricky Hatch with NACO. I guess my question was, it revolves around the examples you used of discounts and credits. I think if you're, to me, it seems different when you're using a discount because of senior citizens or veterans or students. To me, that's a lot different than a 3-year contract and the price, the per unit price decreases over time. And so I have a hard time treating those two types of transactions or estimating those two types of transactions the same way. Am I missing something, or is that why would that be so confusing to have those two different types? The discounts and stuff seem really predictable, very easily estimated, because I know if you're a senior, instead of paying $10 for a ticket, you're going to pay $7 or something like that. So help me understand the difference between that and the year-over-year price decrease.
Is that normally the price decreases get contingent on the amount and you don't know the amount, right? So you enter into a 3-year contract and the first 500 units are one price, the next 500 units have a slower, is still a discount, but now you have an uncertainty of whether you're going to purchase 800 units, 1,000 units. And so the uncertainty comes from the amount.
So are both of those variable considerations? Okay, I'm gonna have to think about it.
I mean, Ricky, the way I thought about this when this first came up, and I'll make sure I say this right, it's about figuring out what the effective rate of the transaction is. What's the effective rate you earn? What's the effective rate that you're going to get charged or pay over the life of that transaction? So when she says it's 3 years, it's like, well, effective rate in if it's one number year one, but it's 90% year two and it's 8% year three. Well, overall, it's not 190 and 80. Overall, it's an effective rate of that. So that's what you're trying to get to. And that's what you're trying to estimate is what is the effective rate. You're not recognizing anything in the future at that point, but you're going to use that effective rate to recognize things over the course of that binding arrangement. So you're trying to figure out what is the amount that I'm going to use to then apply the unit to, right? And so if you think about what she's talking about, what are you estimating? You're estimating the effective rate of the transaction rather than just saying, well, in year one, I paid 100%, in year two, I paid 90%, in year three, I paid 80%. Well, no, what you really did is over time, you paid 90% for the whole 3 years. So you should use that 90% rate over the 3 years rather than using 190 and 80. So that's really if I say it right, that's how I think about it. That's what you're estimating. You're not estimating the total amount to accrue day one because you're not accruing the whole amount day one. But it's the rate you need to book based on the transactions that didn't happen. What rate do you use?
And if you don't have what Alan is calling an effective rate, essentially what you're doing is distorting the cost of service. So in year one, it's a lot more expensive to provide the exact same service than in year three because you got a significant discount. And so this shifting of the cost of service, or in the case of revenue raised, is why this allocation issue comes from.
I guess my question is less on the examples that you talked about. That makes sense to me. But why are we treating a senior discount or a student discount the exact same way as the examples that you were talking about, when it seems perfectly clear what the cost is? We know we can estimate the price with the discount right up front. I don't understand why we're treating putting those in the same category.
Karen?
Karen Karaher, Nazra. So first of all, this discussion's been very helpful. I think we looked at it, especially we had the same question as far as we were looking at it as total revenue level versus transaction level. So very helpful. I agree with the comment about there's a lot of confusion. If there's this much confusion here, there is. I guess one thing we had, as I said, the examples are extremely helpful, very helpful to also have an expense example in here too, just so you see both sides. But we also had a kind of a question about if you start layering, and our example on that is you have a transaction that you know is fixed, but all of a sudden you are collecting payment for it on a foreign currency transaction level basis. Now that you've layered in another component, does it become variable, or is it still fixed, or does it matter?
Oh, thank you for that question. I really appreciate it. So we are just sorting out one of the complexities to fix a variable. There's another component that we're talking to the board in the next meeting about non-monetary consideration, and we have to look a little bit to that, because then what you're measuring is the receivable, right? So at the date in which you enter into a transaction, you define your receivable, your performance obligations is based on the terms and contracts.
And then what do you do the differential between the amount collected and the receivable? That we have to talk to the board about it, but we're not there yet. We're aware. Thank you.
Scott?
Yeah, just to clarify, like if there is like fixed costs at the beginning or at the end, there's no concern about, oh yeah, if I enter into a contract and there's $1 million at the beginning, prepayment, $1 million at the end, no concern about allocating that over the transactions. I think that the concern is the idea that the government would have to estimate the volume over the course of the binding arrangement and then have to back into that like unit price, which then, next year there might be a different estimate and now you have to adjust that. And that's something that I don't think is necessary. And I would not equate that with cash basis accounting. And I think you could make just as easily, you could make an argument that often in governments, that is the economic reality. Like governments don't enter into these contracts thinking they're going to exceed their usage on the wastewater treatment plant. But then when it does happen, then there's a penalty for that, et cetera. Like often they just enter into contracts. But just to clarify my previous comment, not concerned about fixed cost, only concerned about having to estimate volume on all of these things.
Thank you. So the next topic is right of a refund or refundability. So this is a topic that I think we've been discussing in the development of this project, probably from the very beginning in 2018, when the board issued its first due process document, an invitation to comment. And the reason is in existing guidance, if you see in exchange transactions, particularly statement 62, there's a paragraph that talks about recognizing revenue from exchange transactions without refundability. And then the next paragraph talks to you about also sorts of criteria of what happens if there is a right of refund. And so historically speaking, the guidance for revenue recognition has been very tied to refundability. Let me give you an example. I prepay you $1 million. You haven't given me any services. Do you have revenue? But the advance is non-refundable. Come on, Robert, you have to get to revenue. No, it has nothing to do with anything. You haven't performed, but it's non-refundable. I'm never going to have to give you the money back. That has always been the argument. I've never have to give you the money back. Oh, yes, you do have to give me the money back. Remember COVID? We have non-refundable payments of housing and students got sent home, and those non-refundable advances, all the time had to go back to the student. So the problem is we have always confused refundability with performance. The issue is refundability or lack of refundability does not excuse performance. And we did a little bit of research on contract law and case studies. And what we found is that the court of law has never excused performance due to refundability. Refundability is just a protection to the seller so the customer doesn't run away and then we have issues with very fixed costs like in higher ed. And so from that perspective, the board decided that refundability will not inform recognition. Recognition is simply informed by performance. I give you a refundable advance, and it's going to be a liability until you perform. And to the extent that you perform is revenue. If you do not perform, there is going to be a consequence to that. If the customer walks away, then it's revenue out of breakage. And so the board decided not to continue existing guidance in statement 62 that refundability tells you anything about revenue recognition or expense for that matter. It became simply a measurement issue. And so from a measurement perspective, if you have a transaction that you have refundability, a liability should be recognized along with that transaction. It reduces the amount of revenue. So existing guidance already says that. Property taxes should be recognized net of refunds and discounts. And we have this issue with property taxes with some frequency. So a government imposes a property tax in May, and it starts the collection process, and then there's several there's several property owners to file payment in protest. Is there an allowance for a liability for those payments in protest or not? According to existing guidance, there should be. But the guidance only says recognize revenue net of refunds. And so some people have interpreted the net of refunds just means put the refunds when they happen and reduce from revenue.
well, that's really not what that means. And so the clarification is when you impose a property tax and somebody is requesting a payment in protest, you need to make an estimation for refundability. We had a case of a school district who called a few years ago and said that they had a customer had made a payment in protest. And in their state, it took 5 years to resolve the case. And so 5 years later, the courts have said, yeah, you know, this estimation, the amount of the assessed amount is too high, and they reduce it. And so the amount of payment in protest was given in favor of the taxpayer. It was the largest taxpayer of the school district, and it was over 30% of the revenue. So by year 5, they had negative revenue because there had never been an allowance for refundability. And so they're like, okay, so I report negative revenue? No, that's an error correction, my friend. You should have created an allowance all along. And so this is the problem with refundability. It's not intended to go in the year in which I give the refund. It's intended to go in the year in which I impose, I create an estimate. And then whenever it happens, the reality is just a true up, it's a change in estimate. But if you didn't book an allowance, then that's an error, particularly if it was as material as this. It literally wiped out revenue in year 5 of this school district because it was so material. So this is where refundability becomes a pretty important issue. In existing guidance, it's not clear. And so therefore, the intent in the proposals in here would be to clarify. Refundability has no effect on recognition. It has effect on measurement, and it should be booked along with every transaction. Then there is a probability of refund. With that, Pam is going to pose question number 6.
Question 6 is, do you agree with the board's tentative decisions regarding right of refund, and why?
Bill? Bill?
I think I was going to say yes to that, but now I'm not so sure. I guess I need clarification on that last point you made. Are you saying that on ad valorem tax, for example, that a government should estimate what they think somebody might present a lawsuit some point in the future on?
Not in the future, but in that taxpayer. I mean, governments process payments and protests quite routinely, and they know what period it is. And so if you're subject to payments and protests, there's an estimation needed.
If you're subject to protest. So that would mean that every government should have an allowance, as you had stated, for protested taxes.
And
I would love to know the numbers on how many practice
today is not reflective of that, and that's what it causes the problem. If the payment and protest is non-material, you shouldn't have to worry about it, but existing guidance says report revenue net.
But even in your example that you used, how often did that occur? That occurred every 5 years. They had this major lawsuit which wiped out their ad valorem taxes. Hey, if that's where you guys think things need to go, that's great. That seems. Shouldn't there be some sort of evaluation of what's the probability of a lawsuit occurring? How often has it occurred in the past? And then how do you develop all those measurements for a government? I didn't realize that was the extent. I had a totally different response.
Bill,
I heard that.
I don't think we're asking you to predict unpredictable lawsuits that aren't routine. What we're really talking about are the more routine, like every county I know, there's an assessment. You make an assessment, you get your bill, the taxpayer can protest it. There's some appeals board, there's a process. That's the kind of thing we're talking about, that you have enough routine information to estimate and net and apply to the right period, that we're going to lose some of these protests that normally happen. It's not the lawsuit that comes that says this is unfair or whatever. That's not what we're looking for.
But in the example, and I don't know if the example is made to make the point about having the estimate, and that's fine. You could have a one-off lawsuit that would be material and be totally unknown. And, I mean, we see that, right?
And we would deal
special assessments is probably the most common area where you see that occur.
You would deal with that with contingencies, I think, in the same way you do now. That's not what we're asking you to estimate here are those.
I'm just the
infrequent,
auditor, but
unpredictable.
that'll be an interesting conversation with all the clients about, okay, start estimating potential,
That falls under the contingency literature
fair enough.
and won't change.
Okay.
I think Paulina used that example just to make the point, not to say that's these infrequent lawsuits is what we were trying to get at.
Scott? Bob?
Yeah, and in Texas, what we do is we have property under protest, and when they file the appeal, they're responsible for stating what they think the value of the property is. And then we simply levy on that lower value, knowing that in all likelihood, the actual number is going to be somewhere in the middle. And then we have additional revenue coming in throughout the year as those cases are settled. So are you saying that we would now need to estimate what we think those cases are going to settle for? Or is that process of levying on the lower amount and then waiting to see what actually comes in? And the taxpayer, when they file the protest and they state what they think the value is, that's what they pay for their tax levy until the case is settled. So I guess I'm a little confused on how all that are we now going to have to make additional estimates?
So I'm not familiar with the circumstance in which the taxpayer can determine their own assessed amount. I am familiar with that there's an assessor entity, whether it's the county or some other feature that tells you what the assessed amount is. And that's where the differential of the liability is.
Well, the tax assessor, well, it's actually an independent appraisal district, determines what they think the taxable value of that property is based on market value and based on exemptions. And then the individual property owner can protest it. And so, and again, the property owner, when they list what they think the value of the property is, are going to list it very, very low. And the appraisal district, they have all their documentation on why they came up with that as market value. And typically it just ends somewhere in the middle, but we don't try to estimate where that somewhere in the middle is going to be because it will typically settle out within, 6 months, 9 months after year end. And so it sounds like we may be looking at an extra step here that we don't currently have.
David?
David Goldman, National League of Cities. So this is how I would handle it, and maybe you could let me know if this makes sense. So what I'll do is I'll go back for the last 10 years and I'll look at how much property tax we estimated we were going to bring in based on the calculations we do. We have something from the county with the assessed value and all the other information we have every year. We have to turn these forms. And then we'll look at the end of the year, how much did we actually bring in? And then I'll take an average over 10 years and let's say 98% of what we estimated we were going to bring in was actually brought in due to discounts or other things that came up. And then what I'll do is for the upcoming year, I'll book, the whole amount, but I'll take that 2% and put it into some kind of liability or whatever. And at the end of the year, I'll true that up based on what actually happened that year. Is that kind of along the lines of what we're looking for?
I think that's pretty close. I think the only clarification I would do is when you're looking at the differential between your imposed amount and your collected amount, if it has to do, and every government does a different collectability. So there are governments who have a very high collectability because they imposed a lien and then they take on and so if you don't have collectability issues and then the only differential is because you're providing a refund, then that's a reasonable basis of estimation.
Scott?
Scott Davini, AGA. Yeah, I'm good with this one. I mean, it's like allowance for doubtful accounts, right? Yeah, and it's actually kind of helpful that this would be one and the same, because I think in practice, a lot of times those discussions kind of get overlapped, maybe incorrectly, but yeah, it may be an extra step that people have to do. And it may be that some governments don't want to do that because they don't want to tip their hand or something like that. But I agree with you, Joel. It's all under contingencies, and we're good with this one.
But let me ask you a question. I'm sorry. I don't know if I understood. Collectability is allowance for doubtful accounts. This is a different thing for refundability. Is that what you're thinking about?
Yes, it would be
Because
same accounting, different thing.
Okay.
Yeah.
Christine?
Christine Brock, ICMA, and from a preparer's perspective, especially even the smallest preparers, typically the materiality would be a question with this, and any sort of language probably emphasizing the materiality, because certainly many refund policies are put in place not only for the flexibility of the residents or the customers, but also to be able to just be able to, if you have a swimming pool rentals, you've got renting gazebos and pavilions and kids soccer camps. I mean, there's lots of refund, just lots and lots of refund transactions. And emphasizing that materiality would help, I think, because even the smallest preparers will, the term refund will cause, because we do spend quite a bit of time just in administering programs, and refunds is not necessarily, that is not, the number of refund transactions has nothing to do with whether it's material or not.
Agree with your perspective. I think all our standards do have a materiality box. This is the provisions in the statement shall not be applied to immaterial items. So refundability in each type of transaction is not. It shouldn't be.
Anita?
Anita Kovacs, National Association of Colleges and Universities Business Officers. Being that we are colleges and moving away from the property tax example, but moving more to a tuition-based example, I have just, we already have an allowance for doubtful accounts, which we do because we recognize revenue at the beginning of a term generally, but you have to recognize that when I read this, and you might be trying to unhinge the refundability, technically we should be recognizing revenue at the end of a term, but most modern colleges and universities have got multiple terms of differing lengths going on. So systematically, you've got to recognize it at the beginning after the first class session. That's when people have to decide if they're in or they're out, because that's when all the aid processes and revenue for that gets recognized as well. So my bigger concern is just that, would we be having to book a liability for the revenue itself, or is the allowance going to continue to be enough?
So collectability and the allowance for doubtful accounts is not yet part of the topics. And as I mentioned, programmatically, whether a college recognizes revenue on day one or a fiscal year end, that's an internal accounting problem. But by fiscal year end, the only revenue reported should be that has been performed.
I will say that we all have different schemes for that.
And that might be the challenge.
Michelle?
Michelle Waterworth, AICPA. At least from what I understand this to be, looking at existing guidance, at least in GASB 33, I think this is very consistent with how I've been applying GASB 33. Going back to the example of property taxes, in the state of Michigan, anything that enters into a Michigan tax tribunal, so that's payments under protest, we've always looked at those and have our clients estimate an amount that, is subject to that litigation. So I would be supportive of this.
Bill?
Sorry. I think there should be made a distinction, because I think, at least in my interpretation, a refund in an agreement that has a component that relates to a refund, your ability to refund. I don't know if it's quite as clear as a legal suit. allowance is really what I'm hearing. And taxes can get challenged all the time. And there's other governmental transactions that get challenged regularly. And yes, they get evaluated, but I've never seen a consistent application of an amount associated with that off of the general tax revenues or even in the special assessment arena either. So maybe I'm a one-off individual, but I don't think so.
No, and I think that is sort of the challenge. I mean, we observe a little bit of variability in practice, and so that I'm grateful that somebody does follow the standards, but the guidance is not clear. The guidance just says recognize revenue net of refunds, but it doesn't tell you refunds of this year or refunds of last year. So people can make that interpretation.
Well, I object to the categorization of not following the standards, quite honestly. I think it's a function of what occurs in that environment. And there's this idea about what is happening in the government sector. And again, I just don't see this type of issue. There's always the one-off that you had, and that's why I brought that up. Oh, this extreme case. Well, that extreme case, I doubt would have been accounted for even had they done an allowance process, right? So even if they had this offsetting, I highly doubt that it would have covered an extreme example. And that's all I'm suggesting. So I think you need to have clarity about what you're looking for in this, because I don't think in practice it's what you're seeing.
Kimmy?
Kimmy Ellen, NABA Inc. I agree with Michelle that once you enter into those tribunals where you are asking for a refund or reduction, you should be estimating. That's just I would think that would be a normal part of what you're calculating as your end revenue number. And so again, I think it deals with the sophistication and the accuracy of how it's being prepared. But I would think that that's what you would be doing. So if I put on my external auditor hat, I would hope that's what you were doing, because of course accounting is very conservative and you want to make sure that you have the most conservative number possible. But we definitely agree with that.
I think we've got everyone. So Rob Hamilton, NASAC, just wanted to say that we supported with the board's tentative decision on rider refundability not coming into play here. So back to you, Paulina.
So the next piece of measurement has to do with significant financing components. This is a situation where the government purchases a good or service and they're allowed to pay for the good or services in more than 12 months. Do you present value the amount or not? You have a revenue transaction. There's a donation and they promise to give you money in the next 10 years. So $1 million per year. Do you present value that amount or not? And so the question is, when there are transactions in the scope of this project where the payment is larger than 12 months, should that amount be discounted? This was a very difficult conversation. Existing guidance for non-exchange transactions said you might discount if you want to. I have never seen anybody wanting it to, but you're permitted. You're not required. For Category A transactions or 16 exchange transactions, there is guidance in Statement 762 about discounting. And so when we put Category A and Category B together, the board tentatively decided to permit and not require for any. So if the government is a situation where they feel that this is such an important issue that they need to discount, they need to exercise professional judgment and follow the provisions in Statement 62 and discount. If the government determines that it's not in their best interest to discount, then they can report a gross amount for either the revenue or the expense transaction. That's the tentative decisions. Pam?
So do you agree with the board's tentative decisions to permit but not require discounting for transactions in the scope of this project that include a significant financing component, and why?
Michelle?
Michelle Waterworth, AICPA. We absolutely agree with that. We appreciate the flexibility.
Ricky?
Ricky Hatch, NACO, we echo that, the permissive nature to rely on the professional judgment of the preparers that we really appreciate.
Scott?
Scott Davini, AGA, ditto. Normally, we like more prescriptive standards, but in this case, I mean, there's so much that's going on with revenue and expense recognition that I think it'd be better to just give the options, and then you can always PIR and see if anyone's even using it. Thanks.
Dean?
Dean Mead, NFMA. We're not thrilled with the optionality of the existing standards or continuing that optionality. We think it undermines comparability and believe that there isn't a consistent way of doing this, that GASB standards themselves are offer a variety of ways of estimating, some approximation of present value depending upon the type of transaction, but without any overall guidance about how to do it. I think until GASB establishes the way that discounting ought to be done, allowing governments to choose whether to discount or not, and then leaving it up to them to determine how discounting should be done, is a comparability problem from our perspective.
Sean?
Sean Hunstock, APPA. I agree with Dean's comment regarding comparability. Oh, thank you. I agree with Dean's comment regarding comparability. I'm not sure the background or discussion that occurred related to not requiring discounting for Category A transactions, for exchange transactions. And my concern would be, I guess, at some level of entities playing games with the numbers to some extent by discounting expenses and not discounting revenue to come up with certain outcomes that they want to happen that don't reflect economic reality.
Karen?
Man down. Our group supports the flexibility.
So for Rob Hamilton, NASAC, I think we were in slightly of a different approach. I think where we were landed is there had been a lot of effort around essentially a similar approach for SPIDAs and leases where we would discount, and to deviate from that, we found a little bit, I guess I'll say surprising, just because there had been so much effort there and we think we could replicate something similar. Now, not that our group was in favor of giving more work. I think most of our states would probably just opt to not discount since if it was permissive, but just found the philosophical switch a little bit curious. And so I think that's where we were struggling. Would there be some confusion about why requiring it for SPIDAs and leases, but not requiring it for these significant financing components is where we were struggling a little.
They're fundamentally different transactions. In leases and SPIDAs, you're acquiring on day one a capital asset. In revenue and expense, you're recognizing receivables periodically. So there was a little bit of a distinction. In the expense side, particularly, we struggle finding pervasiveness where the vendor would allow the government to pay more than 12 months. We found examples. It was a rare example where a government had purchased something like 800 megahertz radios and they had given 18 months. That was a tough one. But we pervasively see when the government purchases goods or services, the payments are due fairly close and not exceeding 12 months. And so it was the thinking was a little bit the differential, the type of asset that you were measuring, a receivable versus a capital asset.
Sean?
Sean Hunstock, APPA. The one example I can think of is, and it's happened a lot over the last several years, is with transformers. It's becoming more common now that the lead time on those are 3 to 4 years. And the vendors are requiring now progress payments as that equipment is constructed and not yet delivered.
Back to you, Pauline.
So the last topic is consideration payable to the customer. So this was an interesting issue because in FASB topic 606, you have under measurement this topic. And essentially the step is if the vendor is giving, let's say cash, let's make it easy, to the customer, I need to first determine whether the cash payment is for a service that the customer is providing to me or whether this is an incentive. But for the purposes of this project, you have to understand the difference between where FASB was coming from and where we're coming from. In the FASB 606, you're starting the transaction with you have a contract for revenue. And so it's important to know if you're paying the customer for the provision of services. And so the example that we took, this is not a prevalent governmental example, so we had to use a private sector one. I am selling breakfast cereals to a grocery store and I'm paying the grocery store to stock my cereal. That's why I'm paying them money, because they're providing me a service. And so you have a revenue transaction, I'm selling goods, and you have the customer providing me a service. So you have two transactions. In the categorization methodology that the board has proposed, this would have been resolved at the first step. So by the time we're in measurement, we really shouldn't be thinking about, do I have expense transactions or not? That was sorted out at the beginning. And so the only topic you have here left from a FASB perspective is what do I do with incentives? In the FASB side, the incentives had come in very different forms, including the stock of the company, the bonds of the company. I'm not sure if the governments give municipal bonds as an incentive for anybody to enter in transactions. We also didn't see any circumstance in which the government would be providing an incentive to enter into Category B transactions. So the proposals in here that the board is going to be deliberating in this coming meeting is essentially we sorted out all the expense things, so there's no need to worry about it. And so we're just going to take incentives as part of the variable consideration suite of thinking and then put it as part of the estimation and just reduces the transaction amount. And so it's a simplification from what FASB 606 does, but from a perspective that the model in itself would have sorted out these issues. So with that, Pam is going to ask the last question.
Which is, do you agree with the staff's proposals regarding consideration payable to a customer and why?
Feedback. Scott?
Scott with AGA. Yeah, we struggled to come up with an example, but appreciate that it's here and that's simple and agree.
Anita?
Anita Kovacs, Nakubo, and we do agree. And I think I have an example for you. In our wonderful state, we are being required to, every college is going to have at least $10,000 four-year degrees. So if somebody has paid tuition above 10,000 and you're in one of those degree programs, we're going to have to give a refund. So we're going to have to start estimating that. So there's a good example for you.
Abel?
Abel Palacios with ACI. I'm thinking of an example on consideration payable to a vendor. At our airports, we have a lot of construction going on, and payment to vendors are often incentivized for early completion of construction. And certainly it would tie into this clarification. I agree with that, but that's just an example that I'm thinking of, that we would pay incentives to vendors for early completion in the form of a bonus.
Appreciate it. And the only clarification I should have made, so my apologies, is that would be contingent consideration. So I'm going to give you an incentive if you finish sooner.
That's right.
And if you finish after the due date, I'm going to punish you and pay you less, right?
Or pay the same amount. Or late payments, yes.
Or late payments. So those are contingent consideration, and that is one of the topics that we hopefully get to in the next few months. So we haven't resolved contingency. This is just an incentive for you to enter into a contract.
Right.
So you enter into a contract, I'll pay you something, and it's not conditioned to anything.
Thank you.
Any other pieces of feedback? Seeing none.
As I mentioned, we still have a few, we have completed recognition of category A. We have a few pieces of measurement in category B. I mentioned contingent consideration. That's what that sounds like. An incentive for finishing sooner or milestones that's contingent of something happening. The FASB 606 talks about constraining estimation. We have to work through what that means. And it's the conservatism that was alluded a little bit earlier. We're talking about non-monetary consideration with the board in the next coming meetings. So I always tease about the payment of property taxes and bushels of corn. So somebody's paying something other than cash. What do we do with that? We talked a little bit about collectability, which is hopefully the proposals are to clarify that that's limited to customer credit risk, not just to any estimation issue. And then, as I mentioned at the very beginning, the allocation of consideration. So those are the topics that the board is going to be discussing in all the way to May. So we'll see you in March and give you an update where we are with measurement.
Thank you, Paulina. Thank you, Pamela. All right, we are right on time. Well done, everyone. So we have a break for 10 minutes, so we will be back at 11. All right, everyone. So the next item we have on the agenda is infrastructure assets, and I will turn it over to Chair Black to introduce.
Thanks, Rob. This is, all our projects are important, you know, that's why we're working on them, but this is an important project that we are making really good progress on. I think that as I think back, especially to early in my time as the chair, when I would talk to users, this tended to be the thing they talked about the most, this and cybersecurity. And so it's important to think about and remember the problem we're trying to solve here. And the problem we're trying to solve, what we really heard was what for these kind of unique, long-lived assets that governments often are really just trying to preserve rather than necessarily replace, can we improve the information related to those assets? In particular, users told us that the net book value on the statement of net position for these assets often wasn't very reflective of their condition, and they wanted more information on what they would call a deferred maintenance liability. And we've worked through the PV. We've gotten comments from you guys a number of times, including back in July, on the definition and the recognition items. You can see in your materials that we're moving forward, and I'm about to turn it over to Scott and team. I would say the definition continued to be tweaked. We amazingly spent a lot of time on the definition of infrastructure, but in particular, the disclosures. You'll note some of the changes that we made from the PV to get here on the disclosures and the RSI section, which I would imagine is of particular interest to you. So we look forward to hearing your feedback on those and the words that are in this draft standard section. Are they clear enough, understandable enough, what we're trying to do? Look forward to their feedback, but I'll turn it to Scott.
Thank you, Mr. Chair. As Joel said, what we have before you today is the draft standard section that the board will be looking at later this week. We only have one question, just feedback on the various provisions real quickly, because I know that you'll have a lot of feedback, as you always do. I'll summarize some of the changes that the board has made to the provisions that are in this draft standard section as compared to what was proposed in the preliminary view. First, as Joel said, there were a few changes to the definition. Kind of what the board was trying to do is make it clear which buildings should be included as infrastructure assets and which buildings, you know, should not. As well as you can see, there's a definition in the following paragraph that defines what a component is, and this is semi-related to the provision that the board has for those infrastructure assets that are reported using historical cost net of accumulated depreciation, that if they have, you know, significant components, they should be depreciated separately. And that is one of the other changes the board's made from the preliminary views as well, is in the provision related to that, in addition to having, you know, if significant components of infrastructure assets have different useful lives, they should be depreciated separately, is what the preliminary views propose. The board in the standard section as again, kind of, you know, to make it clear of their intent, they added the word, they also had to have substantially different useful lives. So, to take an easy example of if you think something has an infrastructure asset had a 50-year estimated useful life and one of the components had 48 or 49-year estimated useful life, that may not be substantially different. So it wouldn't, because it's an estimate anyway, be worth the government's time to do that. The disclosure section is probably where the most changes came from the preliminary views. The first is one of the proposals in the preliminary views was for governments to disclose infrastructure assets by major class of infrastructure assets. And that was similar to the provisions in Statement 34 that are for capital assets that are required to be disclosed by major class of capital assets. The board changed that from major class of infrastructure assets to networks of infrastructure assets. And in addition, the board proposed an additional disclosure that was to be done with the disclosure that they had proposed of infrastructure assets that are greater than 80% depreciated, if you're using historical cost net of accumulated depreciation. And that was to provide the weighted average age of those infrastructure assets, in addition to the historical cost as well. And the board also proposed to disclose the accumulated depreciation on those infrastructure assets too in this draft you'll look at. There were two disclosures that the board proposed in the preliminary view that did not carry forward. The first of which was a disclosure in the summary of significant accounting policies of the government's policy for capitalizing infrastructure assets or estimating the useful lives of infrastructure assets. And the second is government's disclosure of maintenance expense. And similar to the disclosure of maintenance expense, the board also proposed that for RSI information that not be disclosed as well. And those maintenance expense disclosures, were something the board had proposed. It was applied for all governments, but the board was, as Joel alluded to earlier, looking to try to provide some deferred maintenance type information and have that information out there for infrastructure assets that were reported using historical cost net of accumulated depreciation. So with that, I'm going to be quiet and let you provide feedback.
Bob? Thank you. Infrastructure is something I've struggled with in my over 30 years working for municipalities. I've never felt like what was in the financial statements was a good reflection of what was reality on the ground, the streets I drove on, the streets I knew. And so I'm happy for this project. And I generally appreciate the changes that were made. I will tell you from experience, most public works departments are not good cost accountants, and trying to track that information and get finance from a remote department perspective to get them to properly record what they're spending on maintenance would be very, very difficult. So I appreciate that. The item I have the most difficulty with is the 80% disclosure. And I think GASB is crossing the line from depreciating the useful, allocating the cost of a capital asset to the periods of benefit to trying to have that reflect condition. And the way most governments that I've known, I did ask the ACFR committee for the previous meeting, they were all recording it year by year. And that's how I've recorded it for the last two entities I've worked for, is year by year. And so what happens is you have 2025 additions and 2024 additions. And a major road could easily take 2 or 3 phases, meaning it's going to be in 3 different years of additions. And each year I have the subsidiary ledger, which documents that, and the auditors can look at it. But then the subsidiary ledger is never maintained. It's forgotten. And so what happens is this disclosure is basically going to have me disclose, if I use 30 years, for example, 2001 additions and earlier. And that's what I'll be disclosing. But that doesn't mean those additions are necessarily at the end of their useful life for a couple different reasons. One, I may have come to the conclusion, and I've done this before, that the 30 years was not appropriate and I need to extend it to 40 years. But of course, we handle changes in accounting estimates prospectively. So it may be 80% depreciated, but still nowhere near that 80% mark in terms of the estimated useful life, which I agree the average age makes sense in that case. But the second thing is what I'm seeing is infrastructure is one of those weird capital projects that, or capital assets that has no residual value. The only way I can bring my road back up to 100 is to completely tear it out and replace it. And because of that, and that's very expensive, governments do everything they can to extend the useful life. And what I've seen and what we've done is we do a whole lot of panel replacements for concrete streets that zero in on specific points of failure. And I remember in my previous city, we had about a 3 or 4 mile stretch of a 6-lane arterial that we did a whole series of panel replacements on, and we maybe only touched 15% of the pavement, 85% was left untouched. But the engineers told us that we had extended the useful life 10 to 15 years and brought the condition assessment from a 70 to an 85. Okay, that's a great deal. But what if the 3 of those years were past my 80% mark? I'm going to disclose that road as, or the, historic cost as being 80%, exceeding 80% of the useful life, but I know it's going to last longer than that. And I don't know how to capture that in the financial statements.
Dean?
Dean Mead, NFMA. We have a lot to share, and since you're not kind of just progressing paragraph by paragraph, I guess I'll just share all of it with you. And limiting it to what we consider to be significant things, not typos and stuff like that. The first thing is that the shift in focus, to networks of infrastructure assets, and what might have been a minor edit here to go from examples of infrastructure assets to calling them examples of networks of infrastructure assets, we think has created a problem with these examples. Some of which might be networks, some of them not. And when you combine that with the first sentence of paragraph 4, talking about a network being composed of all assets that provide a particular type of service, there's definitely some overlap in these examples here. A dam, for instance, most often is going to be a part of the water supply function of a water utility. It's going to be creating a reservoir for them that is a part of their collection of water and then subsequent supply of it, as opposed to being a separate item. And in any case, a dam is probably not a network. Drainage networks, it's not clear to us that they're necessarily different from sewer networks. And water and sewer networks tend to be, even in utilities that provide both, tend to be viewed as very different services. They're certainly charged differently to the customers. And so water collection and supply and distribution on the one hand, is a very different service and a very different network from wastewater collection and or wastewater treatment, if they do both. So that's, kind of one big, issue there. So I'm not sure. I think it's gotten muddied here what an asset is versus a network of assets and what qualifies as a network of asset. And, saying that an individual asset that has multiple components is a network, I understand why you did that, but that's really confusing. And this particular example, a road, if you are aware of a government that has a road, as opposed to many roads and all of their roads being a network, using a road, which by its nature is a part of a larger network of roads, maybe isn't the best way of providing an example of something that could be viewed as an individual asset but having multiple components. With respect to paragraph 7, this is kind of confusing. I mean, we would have liked significantly rather than substantially here, and it's not clear to us what is meant on that third line, on line 7, about useful life of the infrastructure assets. Because if we're talking about an asset that has components that have either significantly or substantially different estimated useful lives, then there is no useful life of the infrastructure asset overall to compare it to. So what we think is that this probably needs to say something more like components that have significantly different useful lives should be depreciated separately using their respective estimated useful lives, as opposed to comparing the components to what we think would be a non-existent overall useful life for the infrastructure asset. With respect to the modified approach, there was something in the PV about that we thought clarified something that isn't always clear in the existing standards, which is that if a government fails to meet the requirements to use the modified approach, that it needs to stop using it. And there isn't anything definitive in the existing standards that I'm aware of that makes that clear. So we thought it was great that said that in the PV, but it didn't get carried over into the exposure draft, and we'd like it to be. And then with respect to notes to financial statements, we'd suggest breaking down the infrastructure asset. Well, first saying that the infrastructure assets are, as a group, are a major class of asset, and then saying they should be further broken down by type of network rather than network. And I'll explain why. It occurred to us that there are governmental entities that have multiple networks. Well, the water utility might be one, where they have a water supply network and a wastewater network. But a Department of Transportation might have a turnpike system and a highway system, and one is tolled and the other isn't. And so, if you're saying networks is the expectation here, then that they would have their disclosures would have the turnpike assets separate from the highway system assets, or if you were to use type of network instead, then it would all be highways together as one. And then the paragraph 12 specifically addresses one of the things proposed in the PV to be dropped, but there were a couple of others that we recall the PV suggested would be dropped. So it wasn't clear to us if those are no longer going to be eliminated. That is, the infrastructure not retroactively reported and the idle impaired infrastructure. So it's not clear to us, if those are still going to be dropped or if the board decided to retain them. And then, with respect to the proposals in the PV for notes that the board decided not to carry forward, we're disappointed about the dropping of the capitalization policy because we think that when a government changes its capitalization threshold, it ought to disclose it. And then the maintenance expenses disclosure, we supported that in the PV, but I don't think any of us thought it was going to survive. So the fact that it didn't is no surprise to us.
Ricky?
Ricky Hatch with NACO. We agree with and like and support the addition of the word substantially. We appreciate it because it doesn't increase the workload if there are just minor adjustments. And then on the RSI section, we also agreed with, for the same reasons, that it should not be presented as RSI. We agree because we weren't sure if that would provide benefit to the users, and it lowers the requirements based on placed on the entities. Thanks.
Michelle?
Michelle Waterworth, AICPA. Overall, we really do appreciate all of the changes that you made from the PV, and we are generally supportive. We think a lot of this is a good compromise. The one thing that we continue to note relates to paragraph 10, and that is that 80% criteria. I continue to be confused by the level at which that assessment is supposed to be made. I understand a disclosure requirement is at the network level, but I'm not sure, reading paragraph 10, at what level you require that assessment to be made. So I think there's an opportunity for a little bit more clarity in paragraph 11 or 10. Thank you.
Scott?
Scott Davini, AGA. Yeah, I think our group perceived the exposure draft to kind of be baked at this point. So I'll avoid talking about content. We'll save that for our comment letter. Just the only ask I would have is it would be really great if we could get a glossary section for this one with infrastructure, network, and component included. Glossary sections are always helpful, but I think especially so for this exposure draft. Our group had a lot of, I think the struggle tends to be around those definitions. Maybe unit of account might be helpful, but now I'm getting into comment letter stuff. But I would just say, especially for that glossary, like in paragraph 3, it's not entirely clear whether that second sentence is part of the definition or whether that's part of the example or not. I don't know. Glossaries are awesome. Thank you.
Abel?
Abel Palacios, ACI. First of all, I want to thank the board and actually want to give each of them a hug for the elimination of the maintenance requirement from the preliminary views document. We had several robust meetings with ACI, and the difficulty to develop that and maintain that and report on that was going to be extraordinary. So we appreciate the board listening to our feedback. We did reply to the field test, although late as it was, several months late. We do apologize for that, but appreciate you being receptive to our feedback. Much to my colleague on Bob's side, I agree with some of the comments on the 80% rule. I do believe that's going to be a challenge for some of us, but something we can work through. But overall, thank you very much.
Rob?
Rob Weber, Bond Raiders. I'm not going to go into, and I'm not going to go over everything that Dean has already said because this is a big opportunity, I think, for us. And I agree with much of what he has already said. So leave it at that. But I think this is a big opportunity for disclosures of capital assets. It's one way, whether our methodologies are now looking at the depreciation of capital assets and the potential, because we don't have to talk to every municipality on an annual basis. So we need to understand what potential capital needs those entities may be having coming up. And so any watering down of this potential project, I think is somewhat concerning, because I think we have a real opportunity here to kind of improve the disclosures, as Bob even mentioned himself. I mean, it's one of the things that we really struggle with is are these assets completely depreciated? Are they not completely depreciated? What's their real useful life? So I think this is a big project, I think that we're working on and I just wanted to double down on what Dean has already said.
Karen?
Karen Kierher, Karen Kierher Nazara. So sorry, first of all, my computer's just chosen this moment to shut down and reboot. So I did take a picture anticipating this. So with background, pension systems don't usually hold infrastructure assets. We might invest in them, but we don't hold them. So we have a tangential interest. But the only comment our group really had was, first of all, we generally support it, but the limitation of stationary, I understand the thought process on that, but we kind of thought that was a little bit limiting. And specifically, this is why I had to take the picture. There was a discussion about a Colorado project called SunTrain Project, where they're basically taking energy from remote locations, and they're, instead of using electric lines, they're using trains to transport it via batteries, et cetera, and things. So I think it's just a comment. Again, this is not our area of expertise, but stationary just might be a little bit limiting.
Sean?
Sean Hunstock, APPA. One question I have concerning paragraph 4 is, and this may be a change from the PV, but the wording now is provide a particular type of service, and I believe the word public was removed before service, and I'm wondering if that was intentional. The reason I ask is I think the prior interpretation of that provision by the members of APPA was that applied to infrastructure assets that are included in the delivery of service to the public versus in the delivery of service to the government entity itself. So I'm not sure that that was an intentional distinction with the removal of the word public on that paragraph.
Christine?
Christine Brock, ICMA, and certainly as preparers, we do share some of the comments that Bob and GFOA. We have a lot of members that are even the same between ICMA and GFOA, and just something that I don't know if certainly this project's got a long ways to go, and certainly just how it would be implemented. I don't know if there might be some benefit for the staff that's working on this to talk to preparers about the capabilities of their technology that they're using for preparing, how they keep up with their assets. Certainly there are some preparers that still use Excel spreadsheets. There's others that have software that is much more sophisticated, and certainly the government that I work for right now is going through an evaluation of software, financial software. We're seeing a lot of different capabilities. So there may be some advantages for governments, especially ones that are looking at either new software, or they already have software that can help them to make this to be a better outcome. But I do share the concern about the 80%, not that it's not going to be good information, but just making sure that preparers can do this and could do this in a way that would be providing the best information possible. But I do see Rob's concerns about this is an opportunity to get better information about assets, and I can see that point as well.
James?
James Robbins, ICI. I guess I'll triple down for what Dean and Rob said. Yeah, not too much to add other than we as investors, we're not liaising with local levels of governments or, water, wastewater systems, and any effort to have this standardized and just have a better picture of the infrastructure assets and depreciation is greatly helpful.
Dean?
Dean Mead, NFMA. I have a second set of comments. Can I do those now? I'm kidding. I just wanted to follow up on what Scott said about glossaries and ask a question. I like glossaries too, but I have a concern that if you define things in a glossary, they don't get defined in the standard section. And it's still authoritative, but it gets moved in its placement, and you don't define it in the in a standard section paragraph and then define it again in the glossary. So if that's true, I wouldn't want a glossary, because I think these definitions need to be in the standard section.
On.
And yeah, I wasn't trying to follow up on Dean. That's a good. I understand the point, by the way, of what Dean's saying. I was going to kind of just, Michelle, I think there's something, I've been thinking about what you said a while ago. And one of the things is that whole project that we've been dealing with a lot, and it comes up and it comes up, and we're not really wanting to directly fix this, is unit account. How do governments actually account for their infrastructure? Is it by mile? Is it by road? Is it by bunches of roads? Is it by projects, by year? Like how have they historically accounted for these infrastructure assets, right? And so we're trying to get the words, and this is where, some of these words, the 80% definition stuff are love input on, because we're trying to get the words to say, what we're not trying to do is have people have to redo or have to reallocate their unit of account for their infrastructure assets and say everybody has to do it by project, everybody has to do it by mile of road. Or we're not trying to do that. But at the same time, when you start describing the 80% concept, you almost need at what basis are you doing it? But you do that without saying, but it's this unit of account. So we're walking this very narrow, walkway, if you will, in terms of how to describe that. So if anybody does have feedback on how to do that, I think it's important, because we run up against that in a lot of these conversations a lot, that we realize that governments probably, even in this room, probably account for their infrastructure assets very differently in terms of what their subsidiary records say. And Bob, we hear it by year all the time, but then some people are doing it by actual road mile. Some people are doing it by actual, road itself, and some people are doing it by actual system or net. So it becomes very, very different. And without trying to get everybody on the same page with what that unit of account is, we're trying to not do that. And so that's where these words become a little bit harder to actually nail down. So I say that just in terms of everybody in the room. If there's thoughts or feedback on that, that'd be good to know, because we're trying to not go that extra step.
So Suzanne, I know you had your card up earlier. I don't know if that's in response to Alan, but.
No, not to Alan, but I don't, does anybody else want to respond to Alan? Suzanne Lowenson, American Accounting Association. I wanted to just go back to paragraph 10, and this is for the readability if, moving forward. There's a lot going on there, and that's one sentence. And I know I read it 3 or 4, because we're talking about the reporting at historical cost, and we're talking about the weighted average, weighted average age, which is something that would be new. And then we're talking about, by networks and different things. And so when I look back at the PV, that was broken down into 2 sentences. And I know it sounds like something pretty minor, but I think if somebody's trying to implement a new standard, or if they're new to governmental accounting, that if they were to, it would be easier to digest if that was just broken down.
Other thoughts or comments, particularly what Alan raised? All right. So for NASAC, Rob Hamilton from NASAC, the consensus of the group was that this was moving in the right direction, supportive of it. I think for me, this is probably where I'm a little bit of a different space than the committee that helped develop my feedback. So I'm a little bit like Dean. I'm not quite sure what is meant by a network. I think that was a space where what would that look like from a state context, and trying to just understand what that would look like and how voluminous perhaps our disclosures would be. I think it's just helping me understand what that definition would be and how it's perhaps different than from by classification. I did really like that the clarification on the building piece. I thought that was really helpful, just to understand what is within scope of a infrastructure and versus what's out. I also really did support the clarification with the substantially different. I thought that was a good piece of clarity and moving in the right direction. Like has been kind of voiced by others, paragraph 10, I think, is where I'm trying to visualize what this would look like. Because and I could certainly be wrong, and it kind of alludes to what Suzanne had mentioned, just how much content it really is in paragraph 10. But I looked at this as, I could have some infrastructure assets that are less than 80% of the useful lives, some that are between 80% and fully exceeding, and then those that are exceeding. So I could have like the same asset essentially 3 times. And I think I'd probably have like a subtotal if I'm thinking about this right. And so seeing Alan nod, that makes me, okay, that helps to know that that's the direction we go in. I'm just trying to think, what would be, how does this, we have that guidance that's within the comprehensive implementation guide about not exceeding the useful life, and would that be slightly contradictory? I know this would be level A and that's level B, but I know in Oregon we have used that as if we are still operating that particular capital asset, we extend the useful life knowing that we shouldn't have a capital asset that is in excess of its useful life. So just kind of thinking through what that might be. And then with paragraph 11 around the policy for monitoring, preserving, this being a new one as well. I know for Oregon, when I looked at our statute, I do wonder if that might be a little bit boilerplate as this becomes more, we're just kind of used to it, and if whether that would be beneficial to our users, but just trying to think that it would probably not change a whole lot, but that's some feedback right ahead.
I'll let you go.
Just to make sure that my nod didn't imply something I wasn't trying to imply. No, I appreciate it, but Rob, you weren't talking about your capital asset roll forward when you talked about the 3 buckets, right? Because we're not necessarily.
Okay. That's what my mind went with
in your
that.
capital asset roll forward, you would have your infrastructure assets by network.
Yeah.
But the 80/100 thing is, in my mind, at least something separate from your roll forward.
Okay.
Right. And so when you start talking about subtotals, it started making me worry. You're talking about touching your roll forward. The only place the roll forward, I think in my mind gets affected is by infrastructure by network.
Okay.
Right. Just like capital assets by major class. Right. Versus what I was shaking at is, in your mind, you kind of have things that are under 80. There's no additional disclosures related to that. Then you have things that are 80 to 100. There are disclosures related to that. But the disclosure for that is exactly the same thing as the stuff that's more than 100. Right. And so those disclosures are, in my mind, in addition to separate from your roll forward, which that was only getting affected by the disclosure by network.
I appreciate that clarification.
I appreciate everybody's feedback, and I'm not trying to fill time, but I'd like to see if I'd like to kind of specifically address the users in the room a little bit, not put them on the spot and ask you a question that you have to answer here, but maybe if you do, that's fine too. But as you contemplate your responses or comment letters to the exposure draft, at least consider this. The idea that part of the project here was to try to address this notion of a deferred maintenance liability remains a big deal for the board. Now, the vote on the maintenance expense disclosure was pretty split. It certainly wasn't unanimous. In fact, you may see a couple of alternative views in the exposure draft, primarily, I think, related to the lack of the maintenance expense disclosure. And so my ask of users is, as I listened to the users and what they took from our preliminary views on maintenance expense or deferred maintenance as a concept, it's almost really broken into 2 numbers. One is CapEx maintenance, and one is quote unquote regular or operating maintenance. And I want to say in a way, the PV was only addressing operating maintenance. There was no inclusion of this maintenance amount, at least if governments are depreciating their infrastructure assets. There's no CapEx kind of component to that. And in a way that felt missing to me, and in a way that's really where the 80, 100% and really the weighted average age helps. Because now users, while it's not replacement cost by any means, they at least have enough information to go, here's this old stuff that's either at or near the end of its useful life. And by the way, here's how old it is so that I can put those historical cost numbers, which might be 60, 70, 80 years old. I can put them in current dollar context because I have an age. I can inflation adjust with whatever factor I choose to. So I have some proxy idea towards presumably pretty close to being around the corner, some capital replacement that's going to happen because these assets are near the end of their useful life. The operating maintenance then went away in a way because the CapEx maintenance might be the bigger number, the operating maintenance may not be. But I would encourage users to tell us whether they care about both those numbers, whether the weighted average age is helpful in kind of addressing the CapEx kind of number in a way. Do you care about the operating maintenance number? We'd like that information because the board certainly is interested in doing it. You know, I think Dean said he didn't really expect it to go forward. I guess in the end, so far, he's right. But I think the board had good intentions of trying to address it. And so any context users can provide us about that distinction between those different types of maintenance, the importance of one, both, the other, I think would be really helpful as the board continues on the journey.
Thank you, Joel. Feedback for Joel? Dean?
Dean Mead, NFMA. I actually had that up before, Joel, so I will answer. I'll try to answer your question. But I wanted to follow up on the things that were said about paragraph 10. If you guys were thinking about doing some illustrations, this would be a great area to do it. You know, for a variety of reasons, many of which have already been mentioned, but also it's not clear to me how you calculate a weighted average if you've got assets that have, using the draft's language, substantially different estimated useful lives. You know, whether the expectation here is that each of those components then would be subject separately to the 80% and have a separate weighted average. You know, there's the variety of ways that this could be presented in networks or individual assets, you know, is going to make this confusing. So if you guys think about a couple of really detailed illustrations that would show how you work this out and come out with a disclosure at the end, that would be really helpful. To address the issue that you raised, Joel, you know, as you know from our comment letter, we really disagreed with the board's point of view on deferred maintenance, and its you know, its relative qualities as a potential liability, and more or less in the end begged you to just drop it entirely in terms of discussing deferred maintenance in the basis for conclusions, or at the very least leave out your conclusion that you didn't think it was a liability under concept statement 4. You know, so we were grateful that there were proposals in the PV that would at least try to get to the concept and give us some information that we could use to evaluate whether we think governments are doing a good job of keeping up with the maintenance needs for their assets so that they reach the estimated useful lives they're supposed to, and don't add to the capital expenditure needs of the government in the future. You know, we really liked the disclosure of the maintenance expense for the current period, and then the RSI schedule showing it for 10 years. But we're not unrealistic, and we are well aware that most governments don't collect the information that way, and that the burden of requiring them to figure out some way to do it led us to worry that the numbers that we would be getting wouldn't be great. You know, any of the other users at the table, feel free to smack me later for saying this, but we don't want bad information, and we'd rather not see the disclosure at all than have it be a disclosure of something that we can't rely on.
Harriet?
Harriet Richardson, Association of Local Government Auditors. So I've worked for several boards that don't have necessarily a good comprehension of what they see in the financial statements because they aren't financial type of people. And so I think expressing this information, they're the users of in a manner that they can understand. And to them, when you say, has it exceeded 80% of their estimated useful life, but it's really not at 80% of its useful life, it can last longer. They really just want to know, when are we going to have to put money forward to replace this? And so I think that the way you present the information, the 80% isn't going to necessarily make a lot of sense to them if they don't have to replace it that quickly, but it will make sense to them if they have to replace it quickly. So I don't know that having 80% in there is particularly helpful to them. I think for them, knowing that they have an expense coming up, when is it going to be? How much is its actual depreciated life? In reality, not based on some nebulous number that this is what we thought it was going to be, but this is what it really is. Tell them what it really is so that they can budget appropriately, whether they appropriate the money as a capital expense or a operating expense. Most of them will put it in the capital expense category, not operating if it's capital assets. So I think just thinking about it that way from the people who have to approve the budget for those capital assets, infrastructure assets. Thank you.
Abel?
Abel Palacios, ACI, to maybe address some of Joel's comments between operating and capital maintenance. And in the airports, we do consistently both. But one of the issues that we find is the operating and capital maintenance roll up into our operating expenses because they don't extend the useful life, et cetera. So it will be a difficult challenge in some cases to break out those capital maintenance costs for some of the preparers to include from a capital standpoint, since they are rolling up into the operating expenditure portion. I understand some of the comments on the maintenance costs, fair points as far as what the thinking is to want some of those items disclosed. The issue for our areas is the breakout of those into its particular asset categories. It's a real challenge. So just to address some of the operating versus capital, don't necessarily break that out specifically by asset as well, unless it extends the useful life. Then in fact, it would be reflected in our asset categories.
Scott?
Scott Deviney, AGA, not a user. But just to follow up with Harriet, one of the things that our group had suggested was instead of this 80%, to instead base it on the number of remaining years. So if the category was the amount of assets you have with 5 or less years of remaining useful life, would that be a more actionable number? Would that be a more understandable number? And I think that the other challenge we saw with that is, if you're talking about 80% of an 80-year asset, that's someone else's term, not my term. So, okay, so that's what I was checking.
Yes.
Sophia?
Sophia DeCaro, NGA. Just going along those same lines, that's what my thought process was as well, is just say that maybe it'll face expiration within the next 5 years or something like that. I don't know what it does on the, alternative side, but I think it would be helpful for the users who are trying to budget for these. And then back to the O&M versus capital. I know that at least for the state of Utah, those are budgeted separately. And I don't know how complex it would be because I'm all for less complexity, but it is useful to have the information separated out, especially when you think about like prisons where operations are calculated a little bit differently because they may be using prisoners, for example, versus, a traditional building. And just in terms of how those things are budgeted, I know that we, for example, set aside 1.5% of our total value of capital to make sure that there's enough to take care of that ongoing, for the capital depreciation expenses that come due. So I don't know if that's helpful, but to the extent it's feasible, it would be nice. Thanks.
Last call for feedback. Thank you, Scott. Appreciate it. Thank you, Joel. So we are at 11:51. Next up on the agenda is lunch. And so we will have lunch right outside these double doors. And if you're with us for breakfast, I think it's at the same location. And then we'll reconvene at 1 o'clock. All right. Thanks, everyone. Well, that was an excellent lunch. Hopefully you all enjoyed that as well. The food here was very, very good. It's top notch and gets us all ready for a really good conversation heading into the afternoon. Next up is the topic of subsequent events. And I'm going to turn it over to Jackie to introduce it.
Good afternoon. As many of you will probably recall, the intent of the Subsequent Events Project is to reduce confusion and increase the consistency of subsequent event reporting. In doing this, the board is hoping that we are able to increase the usefulness of the subsequent event information to the users of the financial statements. You may remember that in July, we did talk to you about this at the GASAC meeting and asked for your feedback on the tentative decisions that the board had made as of that time on the subsequent event projects. Since that time, we've considered your comments and made some additional tentative decisions regarding the subsequent event project. Before considering the pre-ballot draft for this, we would like to get your feedback on the tentative decisions that we have made subsequent to the July meeting. So for that, I'm going to turn it over to Emily and her team.
Thanks, Jackie, and good afternoon, everyone. So as Jackie mentioned, this is actually our final meeting if the project pursues according to the technical plan to seek feedback from GASAC members. So our first paper is to seek feedback on the remaining topics that the board deliberated in September. And then from there, we will move into the second paper, which seeks feedback on a draft of the pre-ballot of a final statement that the board will be discussing tomorrow. So we'll start with that first paper, which includes topics related to comparative financial statements, reissued financial statements, scope and applicability, and the effective date and transition provisions. So we'll start with that first topic, comparative financial statements. So the tentative decision that the board made in September, the board affirmed its decision that was in the exposure draft that additional guidance should not be provided in a final statement regarding note disclosures about subsequent events and comparative statements. On this point, the board continues to believe that the guidance in Statement 62 for note disclosures and comparative financial statements is sufficient and appropriate. So those requirements that are in Statement 62 require that note disclosures of prior periods be repeated if they continue to be of significance. The board, in its consideration of whether specific guidance should be provided regarding subsequent events, noted that a government may often determine that the subsequent event note disclosure of a prior period may not continue to be of significance because the effects of such an event would be reported in the current period financial statements and follow the applicable recognition or disclosure requirements. Nevertheless, the board also acknowledged that a government could determine that the information is of significance. And so regardless of that determination, the board believes that the guidance and the requirements in Statement 62 cover that and is adequate. And that will bring us to our first discussion question of the first paper. Do you agree or disagree with the board's tentative decision that additional guidance should not be provided in a final statement regarding note disclosures about subsequent events in comparative financial statements?
Feedback for Emily? Ricky?
Ricky Hatch, NACO, we agree with the decision. We like the flexibility that if the government feels it's significant that they go ahead and disclose it, and the comments about the effect of a prior period or a subsequent event becoming obvious in the current subsequent reporting period totally makes sense to us.
Dean?
Dean Mead, NFMA. We think this is a good decision. The general guidance on disclosure and comparative financial statements should address this. So even though there is something kind of unique about the way in which this disclosure is connected with the period, the guidance, the overall guidance for comparative financial statement disclosure seems to address this in a way that government shouldn't have any trouble in figuring out whether they need to continue to disclose what they disclosed in the prior year.
Scott?
Scott Deviney, AGA. I'll just answer questions 1 through 4. We agree. And for 4, thanks. The modification makes it more understandable.
Sophia?
Thank you, Sophia DeCaro, NGA. Not as ambitious. I'll just take it one at a time. Yes, we agree. I think it's reasonable, like that it provides some consistency in approach, but it doesn't prohibit a government in providing additional information if needed. So I think it's great. Thanks.
Seeing no other feedback, back to you.
Okay, we'll move into the next topic, which is reissued financial statements. So as a little bit of background, and this was discussed leading up to the exposure draft statement 56, includes specific requirements regarding how to evaluate subsequent events when financial statements are reissued. On this point, the board affirmed its decision made in the exposure draft to not retain those specific requirements that were in Statement 56 that explicitly address subsequent events in reissued financial statements. Here, the board continues to believe that focusing on whether the available to be issued date has changed in order to determine whether the subsequent events timeframe has changed is a better approach as compared to considering and relying on whether the financial statements have been reissued. So as part of this project, the board has changed the end date of the subsequent events timeframe from the issuance date to the available to be issued date. And as part of that change, the board has also tentatively decided to clarify and provide some specific parameters around what the available to be issued date is. So that date should be clear as a result of those decisions. This approach taken here with respect to the reissued financial statements, by not retaining those and instead allowing preparers and their auditors to determine what the available to be issued date is and whether that date has changed, also does not require defining what it means for financial statements to be reissued, which is one of the issues that we have been made aware of. And that reissuance is not defined and it may be interpreted differently by different stakeholders. And those requirements in Statement 56 were centered around whether financial statements had been reissued. So the board affirmed its decision and carried forward what was in or not in really the exposure draft to not retain those requirements in Statement 56. And that will bring us to our second discussion question. Do you agree or disagree with the board's tentative decision to not retain the requirements in Statement 56 that explicitly address subsequent events in reissued financial statements?
Feedback for Emily? Michelle?
Michelle Waterworth, AICPA. I think this is an extremely complex area. So I totally understand why the board wouldn't weigh in on it. That said, it doesn't make it less complex. I even think the AICPA standards, if I can say so, are confusing in this area. So just that. I can't necessarily agree because I do think it is confusing and additional guidance is necessary, but I think the overall concepts just in general are extremely confusing. So I appreciate your position.
Sophia?
Thank you, Sophia DeCaro, NGA. I agree with the tentative decision just because There can be delays on when governments have to approve, and the timing can be confusing when there's multiple approvers needed. So I think it makes sense to just default to when you're available to be issued. Thanks.
Dean?
Dean Mead, NFMA. Just following up on what Michelle just said, standards as they relate to reissued statements may be something that GASB ought to look at some point more broadly. But having this one area that addresses it, in the standards, there's nothing about subsequent events specifically. I think that suggests that there ought to be standards related to that, but not address all the other things that could be issues with respect to reissued statements. So I think taking it out of the existing standards, if and when GASB takes it on as a broader issue, is probably the right choice.
Sophia, do you have a follow-up comment? Okay. All right. Back to you, Emily.
Okay, our next topic is scope and applicability. So the exposure draft proposed that the requirements related to recognized and non-recognized events, the requirements of the statement, be applied in the absence of more specific requirements elsewhere in the GASB literature. And the board has tentatively decided to carry forward those provisions from the exposure draft to a final statement. On this point, the board considered feedback that requested that potential overlaps in information, in the information that's required to be disclosed, be addressed. Related to that feedback, the board believes that the potential for overlap in the information that's required to be disclosed would be limited. Although other statements might address the same broad topics or transactions as those that are explicitly identified as non-recognized events, those other standards that address those topics or transactions do not address them in the context of the subsequent events timeframe. So they're addressing the information that's required to be disclosed is related to when that transaction has occurred during the reporting period, and the subsequent events guidance covers the subsequent timeframe. If the standards do address the subsequent events timeframe, then those other standards would be followed in accordance with the proposal to apply more specific guidance if it exists. The board also noted its earlier tentative decision to not provide specific guidance on where within the notes to financial statements specific information be presented. And so if you're thinking about a case where it's comparative financial statements, they are continuing to disclose that prior period information, then that's the subsequent events information. And then they're applying a different standard for the current period. That's the current period information. The government can choose whether and how to combine that information as appropriate. And that would be a matter of professional judgment. Related to scope and applicability, the board also considered feedback to address how the recognized events guidance should be applied as it relates specifically to certain post-employment benefit requirements. Here, the board believes that the post-employment benefit standards, including implementation guidance, establish specific recognition and measurement requirements. And so those, again, following the proposed scope and applicability provisions, those specific standards within the pension and OPEB standards would be applied instead of the recognized events guidance. So the proposed scope and applicability provision effectively covers this circumstance. So all of that taken together led the board to tentatively decide to carry forward the scope and applicability provisions that were in the exposure draft. And that will bring us to our third discussion question. Do you agree or disagree with the board's tentative decision that the proposed scope and applicability provision should be carried forward to a final statement?
Dean?
Dean Mead, NFMA. I have a question for you, Emily, and then depending upon your answer, I may have a comment. So when you were talking about not providing guidance about where in the notes the disclosures need to be made. Is that in response to the comment letters that suggested that there ought to be some guidance like in paragraph 8B of statement 102 that where it talks about some of the disclosures in 102 might overlap with or supplement guidance disclosures made under other standards, and so they, it says they can be combined, or in a way that avoids unnecessary duplication. And I think one of those other statements that must have been thought of when 8B was written was this: subsequent events. So I know I was part of at least one comment letter that made this suggestion. I think that similar language be in this statement that says that the disclosures required by under subsequent events may supplement note disclosures required. Basically the same language. If it makes sense in statement 102 to address the possibility of overlap, it makes sense to us that the possibility of overlap, ought to be addressed in all the other statements that that the board was thinking about when it was developing 102.
I think the context is a little bit different. Like I do think that the potential for overlap is less in the context of subsequent events than it is for 102. But regarding that specific relationship, 102 and subsequent events, the board did consider that, and the way that those words are written and then codified. So it talks about 102 supplementing other statements. And so sort of in that direction, I think the view is that 102 supplements this, not this supplements 102. Then the 102 paragraph 8B is codified within the subsequent events section. So it's the last paragraph of the subsequent events section, and we're not proposing, the exposure draft didn't propose, and the board hasn't tentatively decided to make any changes to how that would be presented. So that paragraph 8B sits in the subsequent events section. So that relationship, I think the board believes, between 102 and subsequent events is covered through the requirements of 102.
We beg to differ. If you wanted to address it, be explicit and don't assume that everybody's going to get it.
Karen?
So thanks for Karen Kara Nazra. So thanks for the clarification. I think our group was concerned that basically moving that language from paragraph 2 to paragraph 6 independently like that, we weren't 100% sure that it was still going to basically apply. We are mostly concerned, obviously, with the pension and OPEB standards and feel that there's enough disclosure requirements in that. So I think your clarification comments are appreciated. And I think if you do anything, it would be really good to make sure that you give examples in some of the materials you put out or anything like that to highlight that those already exist.
Michelle?
Michelle Waterworth, AICPA. We agree with everything that you mentioned and take no exceptions here.
Seeing no other comments. Back to you, Emily.
Okay, the last section of this paper covers the effective date and transition provisions. And with this topic, the board has tentatively decided to carry forward the proposed provisions. And those were that the requirements be effective for fiscal years beginning after June 15th, 2026, and all reporting periods thereafter, and that the provisions be applied prospectively. The board has also tentatively agreed to some minor modifications to the language used to describe those provisions. So specifically, the exposure draft proposed what I'll call some additional language to that you're typically used to seeing in the effective date and transition paragraph. And that was in an attempt to clarify how the effective date worked specifically in this circumstance, because the requirements on this topic relate to events that happen after the financial statement date. However, that was an attempt, and based on respondent feedback, it seemed like that additional language perhaps resulted in more confusion than clarification. And so the board has tentatively agreed to revert back to the more standard language, which results in removing the phrase associated with from the paragraph, if you saw that in the pre-ballot draft as well. The outcome is the same. The effective date is still June 15th, 2026. And so the first year end that will apply the new requirements is June 30th, 2027. And it covers the subsequent events that occur between the year end and the date that those financial statements are available to be issued. And so with that, I will pose the last question of this paper. Do you agree or disagree with the board's tentative decision that the proposed effective date and transition provision should be carried forward to a final statement with a modification to remove the phrase subsequent events associated with from what was paragraph 11 in the exposure draft?
Feedback for Emily. Michelle?
Michelle Waterworth, AICPA. We thought it was clear before. Certainly, I understand in reading it again how people could question the inclusion of that phrase. So I do think the exclusion of that phrase probably makes it even more clear.
Kimmy?
Kimmy Ellen Naba. We also thought it was clear before, but interestingly enough, when I said this exact same thing to someone, to a lower staff member, they were like, "That's not really clear." So I think that this that we do support this because it makes it just even more clear.
Dave?
Dave Goldman, National League of Cities. I would like to be associated with the other comments by supporting the removal of associated with.
Dean?
Dean Mead, NFMA. We think this is a great change. Thank you.
All right. So Rob Hamilton, NASAC, we were supportive of the change as well. All right. Back to you, Emily.
Okay, with that, we will move into paper 2, which paper 2 was the cover memo for a draft of the pre-ballot of a final statement. Again, this is if the project continues according to the technical plan, the board will consider a pre-ballot draft at this meeting, and then a draft of a ballot of a final statement in December. I was trying to get all the dates right in my head. And so this is a final opportunity as we meet as a group to share feedback on the draft. And with that, we just have one question related to the draft, which is what observations or feedback, if any, do you have on the pre-ballot draft of a final statement?
James?
James Robbins, excuse me, James Robbins, ICI. It's kind of a nitpicky comment, so sorry in advance. In paragraph 9 for non-recognized events, I think in subpart A, a debt-related transactions, a little ambiguous because I see the footnote says what it's not, but would a redemption qualify as a debt-related transaction? So if Robinstown, New York or something optionally redeemed bonds, would that be considered a debt-related transaction? I guess it would, but I'm not quite sure.
I do think it is intended that those be included, but I'll note that this will be the board's first opportunity at seeing the footnote. And I imagine we'll have some discussion on 9A. So thank you for the feedback.
Other feedback for Emily? Sean?
Sean Hunstock, APPA. One question I have is for paragraph 5. Says the date through which subsequent events are evaluated should be disclosed in the notes to the financials. I'm assuming that would be in the subsequent event note, or would the expectation be that that would be disclosed in note 1? I guess a follow-up is that would only be required to be disclosed if there was a subsequent event?
So I'll answer your second question first. I think this is required in all cases. So regardless of whether there is information disclosed about subsequent events that meet the non-recognized event criteria or not, the date through which they're evaluated would be information to be disclosed in all cases. Regarding the placement, I think that falls into the category of professional judgment. So the board intentionally hasn't specified where within the notes to financial statements that information might be best placed, and it may be depending on the facts and circumstances. My personal opinion is that it often probably would sit with the subsequent events note if there's other information there, but there is no specific requirements.
Scott?
Scott Deviney, AGA. I understand the standard is fully baked now, so, but I do have 3 technical items I think are still appropriate to consider at this stage. First, we still believe that the correct technical term in the header and body would be recognized subsequent event and non-recognized subsequent event as used in the FASB ASC rather than just recognized event and non-recognized event. In other words, recognized subsequent event is a subset of recognized events. Second, we always prefer good material be in the text of the standards rather than footnotes. Footnotes are challenging when they get codified. It's just, you try to click on them and it zooms you down and across, and just don't see any reason why it couldn't just be an extra sentence there. And then third, would also request that subsequent events and financial statements available to be issued be identified as glossary terms in a glossary section. After going through GAAP structure, I'm now beholden to say that a lot more often. I'm not suggesting that we disturb the standard, just to clarify what Dean was talking about before, just about adding a glossary. Thank you.
Dean? Sorry.
Standing between me and another sip of my coffee. Dean Mead, NFMA. Look, by and large, I think we think this is an improvement over the existing standards, easier to understand than it was before, and definitely echo what Scott was just saying about recognized subsequent events and non-recognized subsequent events, and the fact that they are a subset of obviously everything that shows up in the financial statements, is a recognized event by definition. So I'd hate for this to come back and haunt us later on when we want to use the term recognized events in a broader way, but we've already limited it based on this language. The 2 things one thing that kind of confused us a little bit, the disclosing the date through which the subsequent events are evaluated. I think that could be, useful information to our members, but I'm a little worried about the circularity of it. If that date is the date of the audit opinion, and they don't know while they're working on this what the date ultimately is going to be of the audit opinion. Are they going to establish the date in there, and then the audit opinion is going to be provided, without them knowing what that date is? I'm just not sure how mechanically that is going to work. So perhaps, dealing with this on an exception basis disclosure to say that unless the date through which they considered this is, if it's other than the audit opinion date, they should disclose what it was. But otherwise, don't require them to disclose anything. And then everyone looking at this will know that the period through which they considered this was through the date of the audit opinion. And that actually, both of those things were related to one another. So there isn't a second thing.
Harriet?
Harriet Richardson, Association of Local Government Auditors. I wanted to second what Scott said about adding the word subsequent in for recognized and non-recognized events. And I also wanted to second his comment on footnotes. I personally dislike footnotes. I find when I am reading something, I don't really see that little number that indicates there's a footnote, and I get to the bottom and see the footnote and go, oh, where was that? And have to go back and find it. I prefer, like Scott said, putting it in the text. Thank you.
Michelle?
Michelle Waterworth, AICPA. In general, we are supportive of this. Just a couple comments. In paragraph 4, we had talked before about the concept of all approvals necessary for issuance have been obtained. I think we lost the battle there, but I do appreciate that you did add some additional guidance in the basis for conclusions. So I think that that'll be helpful. And then my other comment relates to paragraph 5, which is the disclosure requirement for subsequent events. I'll just echo the same thing that I mentioned at our last meeting. Personally, and this is my opinion, not that of the AICPA, we have this requirement on the FASB side. I have never seen them include a date that is different than the auditor's report date. And for that reason, to me, this is not really essential information and not helpful in the financial statements.
Harriet, do you have another comment? That's right. Abel?
Abel Palacios, ACI. This might be a little bit of a nitpicky comment, but a question related to debt-related transactions. I'm going to assume that it excludes the obviously routine payments for debt service, but will also exclude PFC receipt of passenger facility charges that we received on an ongoing basis, since it is debt-related, that we would not need to disclose that. I'm not asking for clarification on a footnote, but I'm going to assume in my interpretation that's a routine transaction.
Abel, you're just saying as revenue that's being used to repay the debt.
Correct, because it's all used to repay the debt.
Not consider whatever it is that's used to repay the debt would be debt related just because you happen to end up using it.
Got it. Thank you.
No, those would not be in there.
Great.
Thank you, Joel. Dean?
And Dean Mead, NFMA. Sorry, there was another thing. And that just Abel just reminded me of that. We don't like the footnote, and not because it's in a footnote. We don't like the content. The idea of excluding other kinds of long-term financings when other GASB standards are heading in the direction of treating all of them the same way, regardless of what they're called and regardless of how they are structured. If they involve acquiring a capital asset through a long-term financing arrangement, they all get accounted for the same way now. And so especially for governments that don't have the ability to issue debt independently, and so tend to turn to transactions like leases in order to acquire the capital assets they need. From a user perspective, we think that is every bit as important a subsequent event for those governments as a debt-related transaction. And considering they don't issue debt, they don't take out loans, but they do engage in very material lease transactions. We think excluding that from 9A, diminishes the value of the disclosures to us.
Dean, I'll just note, because the board had a pretty significant discussion on this, and something that they definitely, I think, want to make sure is clear, and the basis attempts to explain this is that just because it is excluded or not specifically part of 9A doesn't mean that it is not a non-recognized event under 9D. So I'll just use this opportunity to clarify that, but I understand your point of view.
I appreciate that clarification, and I don't know if I said anything to give the impression I didn't think the board had a thorough discussion of this issue before making the tentative decision. But the fact that it says in here it's excluded from 9A, I don't think anybody else is going to get that nuance, without reading the basis. And let's just be clear and realistic. Most people don't read the basis for conclusions. So if you're expecting them to catch that nuance by reading how it's explained in the basis for conclusions, it's not going to get across to them because you can't depend upon them to read the non-authoritative part of the statement. So if, and this is, maybe goes back to a comment I made on this project some time ago when I think I suggested that 9D was really the best way to start out here. The principle here, here's what these are the kinds of things that need to be disclosed as non-recognized subsequent events, for example, and then these things that follow. I don't think you'd need that footnote here because they would just be examples. And as they stand now, because they precede the paragraph that says, things that are essential, gives the impression that A, B, and C, you disclose them whether they're essential or not. It would resolve that issue that I had here as well. But the bigger deal for us is we think that the way the footnote is written, that the message they're going to get is that leases and subitas are not subsequent events.
So Rob Hamilton for NASDAQ, my group wanted to pass along, they were reiterated the gratitude on removing the provision around tax rates. So that was a good development. So we're thankful for that. And I'll say personally, I kind of found myself a little bit where Dean was. I interpreted initially that having that footnote that leases and subitas, even if they were significant, would have been out. I found it in the basis for conclusion, so that addressed my original hesitation. So thankful that it is in that clarifying element within the basis for conclusion. Just wanted to say I originally was kind of in the same space when I read it first time. All right, back to you, Emily. And
Okay, hearing no other comments, that will conclude our discussion on subsequent events. So again, the board is expected to discuss the pre-ballot draft at their board meeting later this week, and then the final, a ballot of the final statement in December. So if all goes according to plan, there should be something available by the end of the year.
thank you, Emily. All right, so next up on the agenda is feedback on going concern, uncertainties, and severe financial stress. I will turn it over to Jeff to introduce the topic.
Thanks, everybody. So this is a topic that I know historically we've not had a shortage of feedback on. So I'm anticipating the continuation of that. So as you note, since we've last discussed it, we put out the preliminary reviews, got good feedback about it. So we're going to start, I hope, relatively gently with you today, talking about some scope issues, but then going to start talking about something we got a lot of feedback about, which was the concept of the term going concern and its usage or non-usage in the proposals. So with that, I'll turn it over to Deborah.
All right, thank you. Good afternoon, everyone. So we did issue the preliminary views for this project back in March. The comment period ran through June 30th. We received 38 comment letters. We then held a series of 3 public forums with a total of 25 participants. And many of you around this table participated in the due process, either through a comment letter or the forums or both. And so we really appreciate all of the feedback from everyone that we got on this.
We are just now starting the redeliberation process. So everything that's in the paper for you today, the board has not deliberated yet or redeliberated yet. So we're asking for your feedback in advance of them discussing it. Some of these things they will be discussing later this week, and others will be topics for the months ahead. So the first topic that we want to ask about is related to the big picture scope of the project. The preliminary views propose that two separate sets of disclosure requirements, one related to a government in poor financial condition, which in the PV we called severe financial stress, and another one related to a government that was facing uncertainty about its continued legal existence, which was called probable dissolution in the preliminary views. Stakeholders generally agreed that these two concepts in the government environment are not necessarily the same thing, that being in a poor financial condition does not necessarily mean uncertainty about continued existence, and governments can continue to not, or can cease to exist even if they're not in a poor financial condition. We think there's evidence that users want information about both circumstances, even if it's not both. Now, the next section of the paper is about going concern and how we define it, if we define it. So if the board moves forward with this scope, depending on what they do with going concern, it could mean that the scope of the project is bigger than just what does going concern mean, depending on how that goes. So discussion question number 1 is, do you believe that the scope of the project should continue to include separate disclosure requirements for poor financial condition and uncertainty about continued existence? Why or why not?
Harriet?
Thank you, Harriet Richardson, Association of Local Government Auditors. So I agree with this. And 2 examples, poor financial condition. I worked for an agency, I know you've heard me discuss this about this topic in the past, that is still in poor financial condition and is not disclosing that they're in poor financial condition. They just keep reaching out to the taxpayers for more money. And I think that disclosing that and what it actually means for them is really important to the taxpayers. The second part of it, I think it was good that you brought up that the two aren't necessarily related. Years ago, when I worked for King County up in Washington, there was a separate entity called Metro, which was a weird combination of sewer and transit. And yeah. And they had a board that was comprised of members of all other elected officials from other boards. And so they had to combine with King County because their legal existence wasn't really legal. And so, but they hadn't disclosed to the taxpayers that information. And I think knowing that and disclosing it, they knew it, but they didn't disclose it. And I think disclosing something like that, that's probably an extreme situation, but I don't know. I think having the concept of these two things not necessarily being interrelated is important, and that disclosure of both is important. Thank you.
Sophia?
Sophia DiCaro, National Governors Association. I too think that they can be mutually exclusive, and so it makes sense to separate them out. Sometimes there can be a reorg just because maybe there's a new governor or new legislatures in place, or there's just a shift in policy priorities, not necessarily just due to financial conditions. So I think it makes sense to treat them separately.
Dean?
Dean Mead, NFMA. We agree that they should continue to be separate sets of requirements. We thought the board did a good job in the PV of explaining why they're different concepts, and that governments go out of business for a lot of reasons that have nothing to do with their financial health, and therefore separating that and treating it solely as the probability of ceasing to exist made a lot of sense to us. They don't happen very often. And so the thing that really matters to our members is the severe financial stress side of this. And we wouldn't like to see them get bound together again in a way that keeps us from getting disclosures about financial difficulties until they're actually getting to the point of talking about the government going out of business, or, as is the case in most of the country, they can't go out of business in the first place, and so it's not even a relevant consideration to us. The only thing in those instances we care about is the fact that they're facing severe financial difficulties. So we definitely want to see these continue to be separate concepts within this project.
Ricky?
Ricky Hatch, National Association of Counties. I echo the desire to have these separated. We think that that's a good idea. Having them combined would be like saying that I agree with Mr. Scott here. If I did that, am I talking about Scott Deviney, Bob Scott, or Robert Scott? So it's important to keep them separated for clarification.
Scott?
Scott from AGA. I'm sure it's me that he agrees with.
No.
But we agree, continue to strongly believe that going concern uncertainty is inclusive of both continued existence and ability to meet obligations as they come due, which can be separate causes and should be separate assessments. And I think separating these concepts is a big win for the project. I think it's been the main source of confusion that gets, with the extant that we have problems in practice with, which is discussed in question 4.
Kimmy?
Kimmy Ellen, NABA Inc. We believe that they should be separate as well. They're different contexts, and separating them, we believe, provides clarity.
Bill?
Not sure if this is the right time to bring this up, but I guess clarification on whether you'll do this at some sort of fund level or something would be in this spot as it relates to the financial condition side of it. So whether you'll do that entity-wide only or at various fund levels.
We have not raised that issue in this paper. It will be discussed at some point later down the road. Yes.
So Rob Hamilton, NASDAQ, speaking personally, I thought it makes sense to continue to proceed. I think that the feedback that you're getting is that it is useful, is persuasive, and knowing that, as has been mentioned elsewhere, like GCU is just an uncommon situation for governments, I think it makes sense.
Thank you. So the next topic now is the use of the term going concern. The first thing we'll talk about related to this is another scope of the project issue, which is about consideration of a liquidation basis of accounting. A liquidation basis would mean recognition and measurement provisions, and the scope of the project has so far been limited to just disclosures. So to consider providing guidance anyway about a liquidation basis, we would have to expand the scope of the project to consider recognition and measurement issues. Alternative 1 is to not expand the scope, to continue as we have, just focusing on disclosures only. Alternative 2 would expand the scope of the project to consider providing guidance, which could result in having some kind of guidance on a liquidation basis or guidance not to have one. But either way, that would be expanding the scope to consider it. So discussion question number 2 is, do you believe that the scope of the project should be expanded to consider a liquidation basis of accounting? Why or why not?
Michelle?
Michelle Waterworth, AICPA. The AICPA has not deliberated this question, so these are my views and not the views of the AICPA. Personally, I do not believe the project should incorporate liquidation basis of accounting. I have only dealt with this, so I've been in practice 34 years, and I've only had one situation where we wondered whether or not we should apply liquidation basis of accounting. I think what is confusing is liquidation basis of accounting doesn't come in, even when you have a going concern, it doesn't come into play until you are in wind down stage. So it's at the very, 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 very tail end. And so while all guidance, I think, is helpful if you have that situation, I just don't think that situation in a governmental environment happens very often. And so for that reason, I would agree that the scope should not be expanded.
Dean?
Dean Mead, NFMA. Try as I might, I couldn't think of an example of a prior disclosure project whose scope was subsequently expanded to include recognition and measurement. And there's a good reason for that. So our answer is no. This project is the result of a reexamination of disclosure standards. So the research didn't look at basis of accounting issues. It didn't ask anybody whether they wanted a liquidation basis of accounting or what they would want that basis of accounting to do or how they would use that information. And so I don't see how the board has any of the input that it needs in order to even tackle this issue. So we prefer that the board just go forward with disclosure and not broaden the scope at all.
Scott?
Scott Deviney, AGA. Agree with staff recommendation for just to keep with alternative one and not waste your time with a liquidation basis of accounting. This is just one of those valid differences, I think, between governments and the private sector. Not only is it an unnecessary thing for governments, it's likely to be inappropriate, even in governments that are dissolving under adverse circumstances. I think that it's not the same. It's typically not the same as a private entity where, the debts are, they're not able to pay it stuff. That's been our experience in Washington. Thank you.
Ricky?
Ricky Hatch, National Association of Counties. I agree with Mr. Scott. Just three additional points. One is with only one technical inquiry per year on average, I just don't think it's worth the additional delay in the standard because of the research that would be required. And then secondly, if there's dissolution, the government is already under a lot of stress, and this would create quite a bit of additional cost and burden to an entity that's already under quite a bit of stress.
Bill, do you still have a comment?
I was just going to agree with the prior comments.
Bob?
Yeah, Bob Scott, GFOA, just a clarification on what Scott said. We actually had this situation in Dallas County. Dallas County Schools, which was part of Dallas County, was dissolved by the legislature due to financial and corruption problems. And yet the legislature set all sorts of criteria for how it would be dissolved, which would make general accounting rules on liquidation inapplicable. So every one of these dissolutions is going to be a special circumstance, which likely will have set of rules that the legislatures established.
So Rob Hamilton, NASAC, we were in agreement with the staff recommendation. Felt like it muddied the water to introduce liquidation basis of accounting. I think the other thing that, as is mentioned earlier, that it seems like it would be a major project to go down this path and creating, that level of guidance. And, I also think it's not something that has come up in my time, at least on the GASAC, where even as an emerging issue that there's been a need. So I'm just not seeing the demonstrated need for the time to take to do it. Back to you, Deborah.
Right, so the next topic is the use of a going concern assumption. So other standard setters do provide for a going concern assumption or a going concern basis of accounting, but they also provide an alternative such as a liquidation basis if that is not a good assumption. And GASB Statement 56 currently mentions the going concern assumption. So, however, because there is no alternative, then it raises the question of whether that assumption is necessary for the financial statements. We did hear, though, some stakeholders are very concerned about eliminating the term, particularly because of its relationship with auditing standards, which might require auditors to make an assessment about going concern that management is not. And so we're going to ask discussion question number 3. There are 4 questions in this box, but I would please ask that you only answer question number 3 at this time to help keep the discussion focused. We will get to the other questions, I promise. So right now, we're just asking, do you believe that GASB guidance should continue to include a going concern assumption? Yes or no? And why or why not?
Harriet?
Yeah, I just want to ask a question for clarification. Does this mean you would be taking away the term probable dissolution and going back to this term? I wasn't clear on that.
So that's probably question number 4. So this is
okay.
So the preliminary views did not use the term going concern at all. We had in the project been using that to describe what became probable dissolution of the continued existence part of it. And so what we're looking at here between 3 and 4 is, do we need to use the phrase going concern? If so, how do we define it? But it may not be with our diagrams of the potential definitions, it may be an additional definition on top of, say, severe financial stress and probable dissolution.
Okay, I have to think about that. Thank you.
Michelle?
Michelle Waterworth, AICPA. I don't need to think very hard about this one since I think you were probably talking about us, Deborah, not just us. Yes, we are extremely supportive of including the going concern, at least terminology consideration, back into the GASB standards. I think you mentioned a lot of the reasons why currently in the audit standards that concept exists, and taking it out of the financial reporting framework would essentially leave auditors with that responsibility. And really, this is an assumption that management should make first and the auditor second.
Scott?
Yeah, Scott Deviney, AGA. Yeah, everything Michelle said. I think having the words going concern is really important, and being able to translate from what the audit report says, which is going to use the words going concern, to what the financial statements say, is critical. I think, the financial reporting model we have, it would be correctly classified as a going concern basis of accounting. I think the word, the term going concern as an assumption or an uncertainty or a type of basis accounting, it should just continue to be used in a manner that converges with other standard setters. And, I don't know if I'm trying to answer the question here. I don't know if you need to necessarily label the basis of accounting as a going concern basis of accounting, because again, I don't see that alignment needs to happen. It doesn't have to happen by a liquidation basis of accounting. It just, to me, it has been, and it still can be and should be achieved by just continuing to define going concern uncertainty and that trigger for disclosure in a manner that's converged with other standard setters. Thanks.
Bill?
I guess my answer to this is I think those two definitions are important in the government environment. if to include a going concern one, if that makes everybody comfortable to maintain it, then, I think, GASB should consider that. But I think the other two terms you'll see more disclosure or reporting or whatever disclosure related to them than you would the going concern level.
Dean?
Dean Mead, NFMA. I don't mean to insult Michelle by saying this, but we don't think the audit standards should drive the accounting and financial reporting standards. And when GASB has made changes that resulted in inconsistencies in the audit standards in the past, the audit standards have changed to accommodate that. So we're not wedded to the term going concern. And because there's no consequence other than a disclosure to not being a going concern, it doesn't seem to have much value, as something that's separately evaluated. And the PV proposal to treat probable dissolution regardless of reason, as a potential disclosure, is what will provide our members with the information we need, and we don't necessarily need it to be called going concern.
Other feedback? So Rob Hamilton for NASAC. Looking at, if I'm understanding question 3, the assumption itself, where the going concern is the assumption that would continue to be applied, whether that's appropriate. For me personally, I mean, it just seems, as it mentions in the paper, it's just that's the underpinnings of how we account for things. And so I think having that as an assumption and continuing to use that is appropriate. So I was supportive of using a going concern assumption as continuing, if I'm explaining that well. Back to you, Deborah.
All right, so question 4 now is, if we are going to use the term going concern, how are we going to define it? So there are 4 broad alternatives that are discussed in the paper. They're also illustrated in attachment A. Each alternative that's presented has a reason for it being it. Each one had stakeholder support. And all of them are about kind of an overlay of the term going concern with the 2 concepts of poor financial condition and continued existence. So alternative 1 would be there's going concern uncertainty when there is uncertainty about continued existence, regardless of financial condition. Alternative 2, there would be going concern uncertainty when a government is in poor financial condition, regardless of any uncertainty about its continued existence. Alternative 3 is either they're in poor financial condition or there's uncertainty about continued existence, or potentially both. And alternative 4 is it has to be both poor financial condition and uncertainty about continued existence. The poor financial condition may or may not be the cause or a primary cause, but both of those are true at the same time. So discussion question number 4 is, if the GASB guidance continues to use the phrase going concern, which of the broad alternatives 1 through 4 do you believe should be used to define going concern uncertainty, and why?
Bill?
Bill Nasba, I can't wait to hear the AICPA's response here, but my thought would be 1, and because the financial one is the one that I think is my biggest hiccup as it relates to keeping just the going concern.
Harriet?
I was thinking alternative 3 because it addresses if there is financial condition, poor financial condition that would drive it, or some other reason. So I was thinking alternative 3. And I forgot to say Harriet Richardson, Association of Local Government Auditors. Thank you.
Dean?
Dean Mead, NFMA. In our comment letter, we fully supported the splitting of these two concepts, probable dissolution and severe financial stress, so that disclosures could be required for each regardless of whether the other was relevant. And so alternative one continues to be our preference, so that probable dissolution, is addressed regardless of the reason for it.
Scott?
Scott Davini, AGA. Yeah, continue to super strongly believe in alternative three. But I think what would be helpful for this conversation is, I think something that's complicating the terminology question is, if we're going to lower the bar from insolvency to just poor financial health or severe financial stress, then my group would also agree that, going concern uncertainty is not appropriate term to attach to severe financial stress. And again, that's, I think, something that has been a challenge to talk about throughout this discussion. But yeah, we just continue to believe that going concern uncertainty is an umbrella term that encompasses both solvency and continued existence. And, I hear what Dean was saying with, from the user view, going concern, doesn't really matter as a term. But what does matter to me is, as an auditor, is if I have a situation and we can go to our users and we can say, do you expect that we are going to report this situation in that going concern paragraph? And that's what matters, is can I crosswalk from the situations we have and the real situations that are being disclosed out there to what I'm reporting and saying is going concern. And I feel like we've heard consistently and from our users, it's those two things that really matter. Sorry to carry on a little bit more, but I totally agree that alternative one, and then to a little bit lesser extent, alternative four, have been how some of the preparers and auditors are currently, and in my opinion, incorrectly interpreting the extant standards. So that's one of the reasons our group had really been excited about this project, and we thought this was an opportunity to kind of fix that problem in practice. But that is all for now. Thank you.
James?
Sorry, my name, excuse me. Sorry, my name fell over. Another one bites the dust. In discussions, James Robbins, ICI. In conversations with our ICI members, we prefer alternative one. We'd rather it's just the facts about dissolution, keep it objectives, about continued existence, just keep it as objective as possible.
Ricky?
Ricky Hatch, National Association of Counties. We like alternative one with an alternative four kind of in second place. If a government is in severe financial stress, we think that would be evident as you review the financial statements. However, if they're in probable dissolution, that may not be evident in the financial statements and might require a different disclosure, additional disclosure. So alternative one with alternative four in second. Thanks.
Darren?
Darren Tarleton, HFMA. So I think 2B is the best sort of middle ground where you can keep the severe financial stress as a condition that exists at the reporting date, at or near insolvency. You can have your probable dissolution regardless of financial condition with the probability evaluation. But then going concern uncertainty is evaluating the ability of an entity and whether it's going to be at insolvency using a probability evaluation. So sort of see that, which I think would harmonize with the existing standards. So we can keep the sort of existing framework and the preliminary reviews, but then add uncertainty about the ability to meet obligations over a 12-month period, if I'm understanding this correctly. Thank you.
Michelle?
Michelle Waterworth, AICPA. Yeah, we like version 2 the best. There's significant alignment with the FASB standards with version 2. We did, in our comment letter, articulate that we thought that evaluating financial condition regardless of the likelihood of his existence was the most appropriate way to view this, and we continue to believe that going concern should be evaluated that way. there is a problem with the going concern language overall, even within the AICPA standards, because going concern, when you say those words, people think, well, that means continued existence. That is not what it means, especially when you look at the FASB standards. It's focused solely on financial condition. So the AICPA recognizes that there's an issue with language. The ASB, Auditing Standards Board, is looking at that. Way beyond my pay grade, by the way. But that said, we do think that alternative 2 matches what we envision going concern to be.
Karen?
Okay, I'm not sure this is going to be any helpful at all, but I thought I should share. Most of our group, we were actually very split on this and we were very confused. So most of our group liked number 1, alternative 1 for a lot of the reasons stated, but there was a very strong contingent that liked alternative 4, and they did it by version of sort of excluding all the others. And I'll just share some of they felt like the alternative 1 feedback, the alternative 1 that certainly they should be able to pay their obligations as they come due. And they thought there was a problem with the terms near due to its inherent subjectivity, and the term near didn't seem to be very auditable. They didn't like alternative 3 version B or A, frankly. Let's see, here's the reasons why. The note disclosures related to the mergers and acquisitions was problematic given the confidential nature of some of the transactions. So that left them with alternative 2, 2B, sorry, and 4. And they chose 4 alternatively over that. So we had a very split group. I was on the side of number 1.
Dave?
David Goldman, National League of Cities. We think alternative 3 version B makes the most sense because you have, the red circle. I'm looking at that circle graph that was provided in the backup. The red circle pretty much covers all agencies or cities that look like they're not going to be able to survive because they have probable dissolution reasons. And the green area are just areas that, due to severe financial stress, it's predicted that the government will not be able to continue to exist. If you include everything in the blue circle, you're going to have a situation where you have governments who, at the time of reporting, they are experiencing severe financial stress. However, they're not really, maybe they've experienced this in the past and they've gotten through it and they have a plan to get through it again. So it doesn't necessarily automatically mean that they're going to cease to exist in the future just because they happen to be going through severe financial stress at the current time.
Abel?
Abel Palacios, ACI. We're going with alternative 3, and one of the rationales that I'm thinking of to not only include poor financial condition, but uncertainty of continued existence. I'm going to go back to our COVID years. In our airline industry, we were at a 4% travel population. If that had sustained itself, it would have been severe uncertainty and a going concern. However, that we wouldn't have qualified for a poor financial condition because a lot of our entities have over 1,000 days cash on hand. So we would not be classified as a poor financial condition from that effect. So I really do believe it's either or condition from our perspective.
Darren, I see yours is still up. I'm not sure if that's from before. Okay. So Rob Hamilton, NASDAQ, we were supportive of alternative 3. Just felt like that was the most comprehensive and would be able to capture content well. So back to you, Deborah.
Thank you. So continuing down this road of defining going concern, there are, as some of you mentioned, versions of alternatives 2, 3, and 4 that are presented, again, illustrated in the attachment. This is related to if poor financial condition is part of the definition of going concern, whether that is a current condition or a forward-looking assessment of, say, a certain time to insolvency. And this is just for the definition of going concern. We have a similar question for the disclosure requirement coming up later. This is just, is it a current condition or forward-looking for the definition, potential definition of going concern? Both versions had stakeholder support in our due process. So question 5 is, if the board chooses to define going concern uncertainty, use including poor financial condition, which was broad alternatives 2, 3, or 4. Do you believe that it should be a current condition, which is version A, or a time to insolvency, version B, and why?
Harriet?
So Harriet Richardson, Association of Local Government Auditors, I mentioned alternative 3 before, and I think version A, because I think people need to know poor financial condition, which may not necessarily, which may be known before the time to insolvency is known. And I think that especially, if it's going to be an ongoing thing before they acknowledge, oh, now we really are getting closer to insolvency and need to disclose what that timeline is, that having known the poor financial condition beforehand is important. Thank you.
Scott?
Yeah, Scott Davini, AGA. Strongly support version B, time to insolvency, because it's converged with other standard setters, aligned with audit standards, and I think it results in the most valuable information for users. But I got to acknowledge, I feel like there's a 4-quadrant matrix here of like current condition, forward-looking condition, and then like near insolvency or at insolvency. And I feel like if we're going to have an early warning system, there's only 2 good spots on that matrix. It's either a current condition that's near insolvency, which is what the PV was, or it's a forward-looking assessment for actual insolvency, which is converged in the one I like. So I think that creates a challenge that I've observed and felt with the discussion is, it's like Sudoku, like whatever you say here affects your answer for number 7. So I totally agree with splitting financial health and probable dissolution, but I wish these 2 questions were combined. And I just say too, you totally understand the allure of current condition, that you don't have to project. I get it. I love it. We'd all love it. But the price tag for me is that if I go with current conditions, then I have to do near. And I feel like near is not converged. And it's also not it just can't be done. It's too vague. So that's why I have to go that way. Thank you.
Ricky?
Ricky Hatch, NACO. Disagree with my friend, Mr. Davini. I just think the ACFR or the financial statements should be reporters of fact. And anytime we start to broach into the area of prognostication or prediction, I think that invites challenges, especially in complex situations such as severe financial stress. So that I think I would go with version A on current. Thanks.
Dave?
David Goldman, National League of Cities. I'm just going to read exactly what it says in the report. We recommend alternative B because it excludes governments that are in poor financial condition but do not expect to become insolvent.
Michelle?
Michelle Waterworth, AICPA. We also support version B. That forward-looking assessment is really important to us. And in the audit standards, it does say that if management or if the financial reporting framework doesn't address period of time, that it is up to the auditors, and it does require that forward-looking assessment. So I'll go back to my previous comment. Management needs to go first.
Dean?
Dean Mead, NFMA. Noting that we really want these to be separate. But if they do overlap in some way because of the board decides to move forward with 2, 3, or 4, we still view this as inherently time related, and don't think that just because you say it's time related and you favor version B, that it can't be an assessment of nearing insolvency within the next 12 months, for instance, and can only be an assessment of actually being insolvent within the next 12 months. We think that if you can assess the probability of being insolvent, that you can assess the probability of approaching insolvency or being in some stage of poor financial health without absolutely being unable to pay your bills. And that's inherently important to us, in assessing the risk to debt service payments. If all we're talking about is insolvency, it's too late for us. If they're already at the point where they can't make their debt service payments, we miss the boat. We need to know when this is a reasonable possibility for them, that we're in a situation where we're concerned we're not going to be able to make all our debt service payments next year, and that's the point at which we need to hear this, and not when they realize we're out of money, and that's too late.
James?
James Robbins, ICI. Given I said we'd favor alternative 1, if the board chose to do 2, 3, or 4, we'd go with current condition, and word for word what Ricky said a couple minutes ago. Nothing more to add.
Dave, do you have additional comments? So Rob Hamilton for NASDAQ. Our group was a little bit split. We had some that were of the perspective that preferring current condition, didn't want to have to, what they use, break out the crystal ball and look into the future. Others felt of a similar way. And then we had an auditor group that was part of my team, and they liked that it converges, going forward, because it converges with the auditing standards. So in favor of that. So a little bit split on our side. So back to you, Deborah.
So one more question related to the potential definition of going concern, and this is about mergers and acquisitions. And this has to do with if the definition of going concern includes one of those uncertainty about continued existence ones, which broadly those alternatives were 1, 3, or 4. So if the board chooses to go with one of those, then the question is, should mergers and acquisitions, if that's going to affect the existence, be part of that definition of going concern? Some stakeholders supported the inclusion of them, others supported excluding them. So question 6, if the board chooses to define going concern uncertainty, including uncertainty about continued existence, which was broad alternatives 1, 3, or 4, do you believe that it should include potential dissolution due to mergers and acquisitions, and why?
James?
James Robbins, ICI. Hard no. I think it would be a nightmare from a disclosure point of view.
Dean?
Dean Mead, NFMA. Sorry, I just felt like I needed to go back and look at the wording of the question to make sure I knew whether I needed to say yes or no. We think it doesn't matter why they're dissolving. We like the way the preliminary views proposed probable dissolution, as ceasing to exist regardless of the rationale or the cause. And so if the reason they're going away is because they're being absorbed by another government, that we would presume would be a part of the disclosure explaining why they're going away. And so we think all reasons for ceasing to exist ought to be included in probable dissolution.
Scott? Or I'm sorry, Christine?
Christine Brock, ICMA, and we would say not to include the mergers and acquisitions in this to answer this question. Certainly, the regulatory nature of, especially with local governments and utilities, that there is, when it comes to mergers and acquisitions, there's a lot of additional players, and it's going to be something that's highly regulated, and it's not going to be a black box with the mergers and acquisitions in the public space in any count.
Scott?
Okay. Scott Devaney, AGA. Yeah, I think our group would side with Dean. We just presume if the entity is going away for any particular reason, whether that's merger, acquisitions, any other thing, that it would call into question that going concern assumption, and would be a good disclosure. Not a partial acquisition, not where they're acquiring some other entity, but I'm thinking of the financial statement of the entity that is going to go away. But that said, my group is auditors and preparers, so we'll defer to whatever the user says.
Michelle?
Michelle Waterworth, AICPA. So if alternative 2, which is the alternative we support, weren't chosen, we do not believe that mergers and acquisitions should be included in the definition of dissolution when you define going concern. There's a whole host of issues that we think it could raise. In addition, we think that mergers and acquisitions more closely align with the subsequent events guidance rather than going concern.
Bill?
I think it should be included.
James?
James Robbins, ICI. I guess apologies for being a little flippant earlier. I'm not as specific. I think the disclosing of the sensitive information was more our concern than anything. That's what I meant by like a disclosure from nightmare from a disclosure point of view.
Christine, you still have, okay. Ricky?
Originally, I was going to say, yeah, we should include it, but I hear a lot of good arguments, so I'm going to abstain on opining in that particular thing. But I just think if we do decide to include it, I think there should be some kind of provisions or guidance in regards to disclosing sensitive and potentially legally prohibited information.
Dave?
Dave Goldman, National League of Cities. We agree with ICMA to not having to include dissolutions due to mergers and acquisitions.
Bill?
I agree with the sensitivity argument, and I'm sure that's the big concern. So you could get this narrowed down to when it's publicly disclosed or something like that. But I think the idea, at least as I was thinking about it, was if that entity you had financial statements in one period is about to end, this is the final set. Wouldn't you want that? Shouldn't that be disclosed? So that's kind of my.
Hattie?
Hi, Hattie Mitchell from the FOA. I would agree, no. I think tribes would have concern about sharing that information.
And one more look around here. So Rob Hamilton for NASAC. I think one of the things I was curious about is, and it was touched on a little bit earlier around the users outreach indicator that users want this same information. Just curious on like from an essentiality standpoint or concept statement 7, are they saying from like a breadth or depth of users is essential to their decision-making on assessing accountability, or is it a nice to know? I kind of felt like knowing how important it was to the user community would help inform my answer. I think it was certainly compelling that they felt like it was insufficient based on what's in statement 69. So, I mean, I wanted to be responsive to the outreach. I just didn't know kind of like where they were, and maybe that part really wasn't the question yet, but that's kind of where I was on that.
So when we did the user outreach prior to the preliminary reviews asking about the content of the disclosure requirements, we did specifically asked about how you would use these potential disclosures. And then we asked, would your answers change if it was related to a merger or acquisition as opposed to a dissolution without replacement. And there were enough of those users who said their use of it would not change based on the form of the continued existence. Of course, that was in the context of having a disclosure about it. And this is specifically about the definition of going concern, which are not necessarily the same thing. But that's what we took away from the outreach that we did.
Thank you. All right, back to you, Deborah.
So moving on from the definition of going concern, the last section of the paper is about the financial condition assessment, which the preliminary views proposed severe financial stress as a current condition assessed as of the financial statement date. And so there are two pieces to that. One is whether it is a current condition or a forward-looking assessment, and then what date does that assessment get made as of. So the first part of that is whether it should be a current condition or a forward-looking assessment. We had stakeholders who supported both. Current condition would focus on the known facts as of that time. Forward-looking would be a type of a warning system of things are potentially getting bad. Now, this does not have to be the same as whatever is done for the purpose of a going concern definition. That's why there are two separate questions here. This is for just knowing if the disclosures are going to be required related to poor financial condition. So we'll ask discussion question number 7 on this. Do you believe the financial condition assessment should be a current condition or a forward-looking assessment? If a forward-looking assessment, do you believe it should be to insolvency or a condition less than insolvency, such as near insolvency, as was used in the preliminary views? And for all of that, why?
Sean?
Sean Hunstock, APPA. Our group would be in favor of current condition assessment. It's based on known facts and circumstances rather than assumptions about future events.
Scott?
Yeah, Scott Devaney, AGA. So again, this is the Sudoku with question 5. And, as an auditor, I got to say it's got, needs to be forward looking based on a solvency or a government equivalent state, because that's what's aligned with the audit standards and with other standard setters. And to do something different is to kind of break with what everyone's going to be learning about going concern, FASB definitions in school. So it's just very concerning. Where what I notice is that while there may be confusion about, what does this look like for governments out there? Like when we have those actual situations, we can call up our users and they expect that we will have those situations in our going concern paragraph. So I just would be very concerned about some type of break with that. That's all.
Dean?
Dean Mead, NFMA. We think this should be forward-looking and to a condition less than insolvency. As I mentioned before, we have a significant concern with respect to government's ability to continue to make payments on their debt service, which is something that we need to know about before it happens and not when you've actually gotten to that point. And so we're looking at historical financial information as of the date of the financial statements, but we're always looking forward. And so our concern is that when we finally get these financial statements on or around the date they become available to be publicly issued, we want to know as of that point, are they in poor financial condition and therefore at risk of not making their debt service payments. And although we are also interested in whether they were at that point as of the date of the financial statements, but subsequently recovered. If we were forced to pick one or the other, I think, our choice would be the most up-to-date assessment, which would be, something forward-looking, as of the date the financial statements are available to be issued, so that we're not in a situation of assessing something as of the date of the financial statements, but in the 6 months or more since the end of the fiscal year, circumstances have changed such that that assessment is no longer accurate in either direction. Either they concluded they were in poor financial health then, but they're no longer, or that they were fine then, but now they're not. And if we felt confident that working together with the subsequent event standards that we could catch that, those and these together might resolve the issue for us, but we're not confident that that we would necessarily get the disclosure we want if we were limited to just looking at it as of the date of the financial statements and not looking forward.
Alan, I missed your thing earlier, so apologies for that.
Two thoughts, and maybe we think about this is this question to me is we're tying it back to going concern. I wouldn't. Because we could literally have a severe financial stress disclosure conversation and have it have nothing to do with going concern. So this is not real. So this doesn't necessarily have to be about going concern literature or going concern standard. This is about if we want to have disclosure related to severe financial stress, but going concern aside mentally for a minute, what would you want it to be? A current condition or a forward-looking assessment? Having nothing to do with going concern. That's really the question, Tom. That's really this question.
Bob. No. We'll go with Michelle.
Scott.
I'll take it. Michelle Waterworth, AICPA. I'm glad that you mentioned that, Alan, because that's where I was going to go with this conversation was, and it's difficult, right? It's difficult to separate going concern. And so, by the way, our letter and what the AICPA deliberated was all focused on going concern. So these views are my views, once again, not those of the AICPA. But I have been playing around with this idea of if there's a world where you can define going concern as a forward-looking assessment based on a definition of 12 months to insolvency, somewhat similar to what it is today, but then take your concept of near insolvency, which I understand is very different, right? And sooner should be much sooner than insolvency. How much sooner is up for deliberation, right? Probably not months, probably maybe years. I don't know. Hard to say. That devil's in the detail of that definition. But could you layer the concept of going concern with this concept of near insolvency, which should happen much earlier, and make that a current assessment? I don't know the answer to that question, but I'm playing around with that idea in my head.
But Michelle, I appreciate where you're going because where you're going is you said it much more eloquently than I did actually, but think of them as two different things. If you do think about this umbrella concept, it's even a bad word, but this concept of how to integrate going concern into how it relates to probable dissolution and or how it relates to fear financial stress, that's one thing. And that was the chart that Deborah was just showing. But now you take a step past that and go, well, what if we're now talking about just severe financial stress? And that's about near insolvency. And that can happen, to your point, years before you get 12 months from insolvency. And that could exist for many years before you ever get 12 months from insolvency. And oh, by the way, you may never get to 12 months to insolvency. And so this idea of severe financial stress actually gets, in our mind, gets disclosures on the table by governments much earlier than they do waiting until 12 months from insolvency. And so this really isn't about, to your point, this question is really not about going concern at all. It's about, do we do it as a condition as of year end, time to be discussed, when did the assessment be discussed, or is it just always forward looking? And that's really the question on the table. So I appreciate where you went with that.
Scott?
Scott Deviney, AGA. Yeah, just to respond to Alan's question. Yeah, it's hard for me to do that because when I think what freaks me out about this is that the going concern that I've got to report in the audit report, which again, understand that's a rare occurrence, but for our office, like we've got a couple of them every single year. So I'm dealing with real situations. that's somehow going to be absent from GASB standards. And that's how I'm reacting to this. Like, first and foremost, well, I mean, that's what, I mean, I'm sorry, that went away with the PV.
Those are two different conversations there, Scott. Whether we bring that back was the first three questions, was the first part of the conversation. So whether we bring going concern back was the first part of the conversation. We've now moved past that. Now we're no, but this no, but it's important. But it's a really important distinction. The first part of the paper was just about whether or not we bring this idea of going concern, because it's really important to the ASCPA, back into the project and deal with it in some way, shape, or fashion. Deal with it. It's not the best word, but deal with that. Move past that. Do we also want severe financial stress disclosures, which have potentially nothing to do with going concern?
Yeah.
And so when you think about severe financial stress disclosures, you have to put going concern aside and don't think about it. Look at a government that's in severe financial stress, that may never cease to exist, that may be way more than 12 months from insolvency. And should we be having, and do users want a disclosure related to that? And we hear that users say yes. And so now it's about how to define it.
Yeah, I think that's a spider web, and it's really hard to ask for one without the other, because it's all on the table. But in any case, just to directly answer that question, I mean, I think an early warning can be like, it's possible to do both, but I feel like the forward-looking is far superior, because if we're talking about current conditions that are near, I mean, you should be able to see that from the financial statements. And the only thing that you're adding is you're adding like a disclosure about like, hey, government, like just, you know, user, you could come to all of your own conclusions, but now the government has to use its own judgment to be like, hey, I think that we're near, which I think is highly problematic. And given that it's hard to really define that. Whereas the forward looking is something that I think is operationalized. So that's my answer is I don't think that we need both. And I think that with the current conditions near term, I don't know what is really adding, because other than the disclosure, like forcing governments to say that, hey, we're bad, when anyone should be able to see that themselves. And I think do that with their own risk tolerance, because that is the challenge with the near term is it's trying to, you know, it doesn't have the risk tolerance. It's just saying everyone use your judgment. Hopefully that's helpful.
Dave?
David Goldman, National League of Cities. So to keep myself on track, let me read the question. Do you believe the financial condition assessment should be a current condition or a forward-looking assessment? I think it should be a forward-looking assessment, because I think, it says why. So I think it should be a forward-looking assessment because I think that'll be more useful to the users of the financial statements. Second part, do you believe it should be to insolvency or a condition less than insolvency? I think the point of the disclosure is to talk about insolvency. So I think that it should be focused on insolvency.
Harriet?
Harriet Richardson, Association of Local Government Auditors. So hearing what other people are saying, I'm going to be a little bit different here. I'm going to say current condition and a condition less than insolvency, because I think if the government has to acknowledge that they have that they're in severe financial distress, even if they aren't near insolvency, it may force them to try to address it before they reach the point of being near insolvency. And so by acknowledging it, yes, I agree, you should be able to see it in the financial statements, but I think forcing them to acknowledge it brings a different aspect to it, to what the government may, how the government may react to that. Thank you.
Bill?
I'm very much aligned with what was just stated. I just do want to ask, financial condition assessment and severe financial stress are two, in my mind, are two separate things. I look at financial, what you can assess financial condition, it could be great, right? But you could also assess it and it could be horrendous. So, so clarifying where you're headed with that discussion, might be relevant, because I almost thought, Alan, that you were saying, well, when you think of that question, think of it under the stress side of it, not on potentially the positive side of it. I think, you can make an argument, maybe talking about the financial condition assessment, management making some sort of assessment that could be properly evaluated by an auditor might be beneficial to the reader of the financial statements. And really, ultimately, in my mind, that would come down to trends, because at least over some period of years, what was going on with that government? Was it constantly losing cash? Was it constantly understating, underachieving its revenue goals, things like that? But I do believe it's a current position is better. Although, and I'm not clear, current meaning date of the financial statements, or current meaning as of the issuance date, or the date available for issuance? To me, exactly. So there you go.
Rob?
Rob Weber, Bond Raiders. I'm going to agree with what Dean was saying earlier about missed payments. Again, I'm not even so sure it's missed debt service payments. It's just missed payments in general, and putting bills in the drawer. Obviously, that's going to eventually lead to missed debt service payments. But again, what Bill was asking, that question of what is current versus what is forward looking. Because if current is as of the day that the financial statements are released, then I'm fine with it. It's kind of forward looking as it is anyway. But if it's current is as of the day that you released them back in December, and now it's July, that's 6-7 months of information that I don't have. And that's not helpful if we already know that government has started putting, has started to already put, expenses into the drawer and not pay them. So, I don't know how you define that, but however you define it is when those financial statements come out, I want to know what the current financial situation is of that local government or that municipality.
Debbie?
Debbie Miller, National Association of State Treasurers. So as we sit and I've heard everybody's comments, things come to mind in practice where if vendors are not getting paid timely and that kind of thing, it's usually known, I think, prior to anything. I mean, I guess forward looking would be more of a chance, but there's usually also very different revenue projections based on the source. So I think there's a lot of different considerations, and this could be a very different disclosure based on, like we've been talking about, if it's current, forward-looking, date of issuance, and that kind of thing. But I will say from practice, it's pretty well known if you're in severe financial stress prior to a financial statement disclosure, in my opinion. Thanks.
Back to you, Deborah.
So one final question, and this is about whether the assessment, and maybe I should clarify that we're talking about you make an assessment of the financial condition, and if it meets whatever criteria we say, then you have to make the disclosures. That's what we're talking about. Yes, you can assess it and it's great, but then you don't have to make the disclosure. So we're focused on if they do meet that criteria, whatever it ends up being for the disclosure requirement. And that's whether the assessment should be as of the financial statement date or the date the financial statements are available to be issued. We, again, had stakeholders who supported both all of those alternatives. For the financial statement date, it's the disclosures would then provide more information about the amounts that are presented in the financials as of that date. For the issuance date, what we heard just a moment ago is people want perhaps the most up-to-date information about the government's condition. So we think that people who advocated for the issuance date would also want it as of the financial statement date. If there were conditions, perhaps if it was bad as of the financial statement date and got better, that the numbers in the financial statements would still show a not so great condition, that users would still want the information about that. So it's really about, should there be additionally a requirement as of the available to be issued date. There are some theoretical and practical concerns with requiring a disclosure or an assessment as of that date. Theoretical, based on the purpose of the financial statements, is to provide information as of and for a period ending on a certain date, not intended to give all the up-to-date information. The practical concerns, a reason why the board did not propose that in the preliminary views, were concerns about the availability and reliability of information to make that assessment. So with that, our last question for discussion today, question 8. Do you believe the financial condition assessment should be made only as of the financial statement date, or both as of the financial statement date and as of the date the financial statements are available to be issued, and why?
Sean?
Sean Hunstock, APPA. I would support both. My assumption is that this in practice is already a part of the subsequent event discussion that is had with the preparers when the management letter is signed and the audit opinion letter is drafted. That the last question my auditor always asks is, are there any subsequent events? And I would see this within scope already of a subsequent event. So I think it should be both.
Dean?
Just a quick question, Dean Mead, NFMA. So would a third option not be only as of the date the financial statements are available to be issued? Or is there a reason why that's not one of the options?
Yeah, as I was saying, there's really, like, to Scott's, quadrant matrix thing, there's, if they meet whatever the condition is as of the financial statement date or the issuance date, and they could be in one or not the other, or could go back and forth, or both, or either. I don't know what I'm doing with my hands at the moment, but
But it's
We-
working
we
for me.
died-
It's making your comments come alive.
So there are theoretically, if they're that bad as of the financial statement date and the issuance date, or they're in neither, or they're bad and they get better, or they're not so bad and they get worse. And it's really between those last two, of if there's a change between there, and if they're in such bad condition that they're going to trigger this disclosure, at least the way it was intended in the preliminary views, it should be pretty obvious from the face of the financial statements that something's not good. And so if it was only an issuance date assessment, and maybe something happened and they improved until then, or maybe it took a long time to get those financials issued, and they'd had time to turn things around, then you have a possibility of the financials showing it's bad, but then there's no disclosures about it. And so that's why we don't think that that's really what anybody who supported the issuance date assessment would want to lose that.
Sure.
And why we're not asking about that as an alternative.
Yeah. So this was one of the primary concerns that we expressed in our comment letter about circumstances changing in a way that the assessment made as of the date of the financial statements is no longer relevant by the time the financial statements are in our hands. So I think, we would like to be confident that when this is paired with the subsequent event disclosures, that it would capture those potential circumstances that we laid out in our letter. They were fine regarding their severe financial stress assessment as of the date of the financial statements, and then something happened. I don't think we have any concern that that's going to get captured. I think we've generally observed, and it may be that particular provision of the draft statement that non-recognized subsequent events can have both positive and negative impacts, that it will remind governments that not all subsequent events are negative events, and that if they did do the disclosure that said they were in bad shape, and then a fiery chariot from heaven came down and saved them, in the interim, that they would mention that in the subsequent events, that package of standards would work for us, and we'd be more comfortable with the date of the financial statement assessment, though we still think they ought to be, looking forward and not ignoring things that they know are coming. But a lot of that depends upon governments realizing that subsequent events can be positive developments as well. But I can count on one hand the number of times I've seen a subsequent event disclosure that said, hey, this bad thing was hanging over our head. Like there was we were worried we were going to lose this big court case, and hey, we won. I've never seen that disclosure. The only disclosure I've seen, other than the things specifically required, like debt issuances, are bad. So we need to feel confident that improvement from the date of the financial statements is going to be reflected in the notes as well.
Scott?
Scott Davini, AGA. So I'd say both, to not presuppose what the disclosure is and et cetera. But yeah, I think at the financial statement date, that's extant, that can be gamed, and it's just less valuable and it's not converged. And so to get it as of the date they're available to be issued, I think is a real positive that we were looking for this from this project. Thank you.
Suzanne?
To be issued. I think that it's a useful thing that if we could do it at both, because there's the known issue of municipal audit delay, and so this is one way of this is a serious issue. So severe financial stress. If we can update it at the time that the reports are about to be issued, that's more of an update. I would look to the auditor. That's more of an update. Whereas going in and saying like, oh, we're going to find SFS at that issue date, that's like going through more audit procedures and versus just an update. So I would say that you could get additional information by the latter date, and that it's also meaningful and it's helps with audit delay.
Michelle?
Michelle Waterworth, AICPA. Again, this is my position, not something that the AICPA debated. And I'm going to be very positive thinking. So when GASB builds back in the concept of going concern, and that is determined at the date the financial statements are available to be issued, I think you could also make the assessment of near insolvency at the same time. So I would be a proponent for both as well.
Well, for Rob Hamilton for GASAC, on my committee, I had some that were in favor of both, had some that were in favor of just the date of the financial statements. Kind of a split amongst the preparers and the auditors. I can say personally, and it was laid out in the paper, I don't know how I would ever give the information in a manner sufficient to be able to help the auditors make that assessment as of the date of the financial statements. It takes us 6 months for a reason, and to be able to gather enough information based on whatever that severe financial stress category might be, if it is payables being placed in the drawer, we have 85 agencies. We're not even a large state by comparison with some of our peers. And I don't know how we would do that. I also think of things around grant distributions. And if there's a federal award and we're waiting on a reimbursement request, to get it as of the date of the financial statements, you mentioned it in the paper that it's not real time. We cannot get it that quickly. And to be able to forecast forward there, we just would have no capacity to do that. And then that would be a constantly moving target because it would always be the date that financial statements are available to be issued. So I just don't know how that would at all be practical for us to be able to gather whatever concern that we have around the severe financial stress, to be able to demonstrate to our auditors that that has been, whether or not satisfied or whatever it is, as of the date that the financial statements are available to issue. I think we're running into a practical really prohibition. It's not external, but we just could not do that, as I understand what's being put forward. And I thought, the information that the staff put together in the paper really captured it well, what would be my feelings on the topic. Let's see, someone else. Okay, back to you, Deborah.
That concludes our paper for this meeting. So thank you very much for all of your input. Stay tuned as the board deliberates over the next few months, and we'll report back with what they tentatively decide at the next meeting.
All right, so we are ahead of schedule if you've ever been looking at the agenda. So we have a break right now. It's from 3 to 3:15. And then when we come back, we will have a discussion on the GAAP structure pre-agenda research. So 3:15, everyone. All right, everyone, we have coming into the final stretch of our afternoon. Next up, we have the project update on the GAAP structure pre-agenda research with Emily Paul. So I'll turn it over to you, Emily.
Thanks, Rob. Okay, so we have a project update for you guys. The purpose of today's meeting is simply that we are going to walk through the research activities that have been completed and talk about what is forthcoming. We don't have any formal questions for GASAC members, but we are happy to answer questions either throughout or at the end. So feel free to raise your card or raise your hand. And with that, we'll get started. So today we're going to talk a little bit about the background of the project, its history, and the reasons why we're doing this project. The phases of the research. This project is being conducted in 2 phases, and we're currently in the 2nd phase. So we'll talk a little bit more about that. We're going to focus a little bit on the working sessions that we've held with the consultative group and what those looked like. And then finally, we'll conclude with what we're currently working on, which is a first due process document, a discussion memorandum. So project history. So this timeline just shows a little bit of where we've been. So the pre-agenda research for GAAP structure was added to the technical plan in August of 2023, which I guess is 2 years ago now, but you blink and here we are. We conducted a first phase of the research between September 2023 and March 2024. And then in April 2024, a 2nd phase of the pre-agenda research was approved. We've been in the 2nd phase of the research, and that is where we currently are. So we're going to go into the specifics of each phase during this update. Reasons for the research. So the whole origin of this project goes back to our dual authority structure that we have at the GASB. And what we mean by that when we say dual authority structure is that we have original pronouncements that are issued, statements, for example. Those contain authoritative standards, authoritative GAAP. And then that GAAP is incorporated into the codification. And when it's incorporated into the codification, the content retains its authoritative status. And so the result of that structure is that we have 2 sources of authoritative GAAP. We have authoritative GAAP residing both in the original pronouncements and then also in the codification. This type of structure is different than other standard setters and specifically different than
The FASB, which has a single authority structure, their single source is their accounting standards codification, and that's their only source of authoritative content. So we have received feedback from stakeholders on our dual authority structure. Often it's raised as part of a due process document, for example, an exposure draft. Sometimes stakeholders, when they're reviewing exposure drafts, they're looking at codification instructions. There's complexity associated with the review of those, and feedback that we've received has indicated complexity with finding and using all relevant literature because of or as a result of the dual authority structure. We've also received feedback from stakeholders that suggests that we move to a single source structure, and sometimes those suggestions are specific in saying that we should move to a single source codification structure similar to the FASB. There's also been some GASB staff concerns. We do use and maintain also the dual authority structure, just like our stakeholders do, and that becomes more complex as more standards are issued and as the GASB reexamines and amends existing standards. With each statement that's issued, the process has to be undertaken to maintain that dual authority structure. So that led us to conduct research on this topic. The research phases, we have phase 1 and phase 2. So the initial objective of this research, which started in phase 1, was to evaluate the effectiveness of the current dual authority approach to communicating GAAP. So evaluate our current dual authority structure. And then the results of the first phase informed the board's decision to pursue a second phase of pre-agenda research. And the objective in that second phase is to determine what a potential single authority structure would entail and whether such a structure would be operable. Conducting the phase 2 research is not intended to imply that a conclusion has been reached regarding a future structure. Rather, what we're doing in phase 2 is intended to inform whether a single authority structure should be pursued and what it could look like, and then, or as an alternative, determine whether the dual authority structure should be retained and whether there could be any improvements. So just because we're exploring a single authority structure in phase 2 doesn't mean that a conclusion has been reached that we will be moving to a single authority structure. So I'd like to highlight what we did in the phase 1 research activities. Again, these were conducted between September 2023 and March 2024, and then the second phase was approved that April. So the primary focus of the phase 1 research was looking at how GASB stakeholders engage with GASB literature. Phase 1 research considered issues that include which sources of GAAP do GASB stakeholders use? And here I'm using the word source really to mean which type of document. So do they use standalone pronouncements? Do they use the OP collection, the original pronouncements collection? Do they use the codification? Are they using these in combination with each other? So which documents do GASB stakeholders use, and what is the extent to which they're using them? We also considered how stakeholders use each source. So not only which ones are they using, but how are they using them, for what purposes? And then finally, what are the benefits and challenges associated with using each source? The research activities that we used to conduct this research included a survey of preparers, auditors, and users, interviews of preparers and auditors, and an assessment. We also did an assessment of our internal processes and procedures. So the survey that we conducted primarily focused on which documents and to what extent. And then the interviews focused on how the documents are used and the benefits and challenges. And I know some of you in this room participated in this phase 1 research. So again, thank you always for your participation in either the survey or the interviews or both. Thank you. So I'd like to spend a little bit of time talking about what we found in conducting the phase 1 research, so our results and preliminary conclusions. So One of the focuses and what we found from the survey was the prevalence of use of GASB documents. So some fun stats from our survey. So first of all, too, I'd like to note that we had 741 respondents to the survey, and that was a great survey response. So we were really happy with that. And of those respondents, most 92% use at least one GASB document. So that was good to hear. So that was either a standalone pronouncement, the OP as a collection, or the codification. Of those respondents that used GASB documents, more than half use a combination. So they're using the documents in conjunction with each other. We found that relatively few respondents use the OP collection as their primary source. And so when I say OP collection, when we were printing and publishing, those were in the kind of maroon books. They were the accumulation of the standalone pronouncements, but they would be shaded or barred with the amendments. Now that's available through GARS, the OP collection. We found that relatively few respondents were using that as their primary source. Instead, the research indicated a heavy reliance and relatively high use of standalone pronouncements. And so what we mean by that was either, the individual Blue Book or the downloadable now PDF from the GASB website. We did find that documents often were used in combination. So for preparers and auditors, primarily that were using standalone pronouncements and the codification, when we looked at how they were splitting their time, if they used those, it was about a 60-40 split. So still 60% of the time in the standalone statements, 40% of the time in the codification. And if they were using all three documents, standalone pronouncements, original pronouncements collection, and codification, that was a 50-20-25% split. So still in all cases, highest use of standalone pronouncements. Our research, the interviews primarily spoke to how the documents were being utilized. And what we found from the interviews was that the standalone statements were widely used at issuance and during implementation. And certainly that makes sense for them to be used at issuance. At that time, they're often not incorporated into the codification. We also heard from interviewees that they're most familiar with the standalone statements. That may be the way that they stay informed about GASB activities, and the standalone statement includes the basis for conclusions. We also heard interviewees note difficulty of understanding impacts on existing standards. So when they were using the standalone statement, the primary way to determine the impacts on other existing standards is either through the amendments paragraph up front, which tells you the other statements that are being amended, or through the codification instructions. We found that the COD was extensively used by most auditors and some preparers after implementation, or if the guidance has been amended many times. So Statement 14 was an example that we heard given a lot in the interviews. Most auditors and some preparers said, we don't go back to Statement 14. We're looking at the codification for the guidance related to the reporting entity. Auditors and preparers often said, too, that they transition to using the codification after the implementation of a statement. So they noted that at some point it seems necessary to make the switch to looking at the guidance in the codification instead of in a standalone statement, but that making that switch can be fairly challenging. Many interviewees noted that the codification presentation is extremely helpful to have all the guidance in one place. It's comprehensive. But that at the same time, it may also be difficult to find because they're familiar with the standalone statement. So then knowing where to go in the codification can be difficult. That in some cases, there's the duplication of guidance within the codification, and that sometimes it seems like you lose the complete narrative that existed in the standalone statement when you transition to the codification. When we looked at our internal processes and procedures, we noted that our dual authority structure really affects all stages of the standard setting process. An awareness of the requirements as they are presented in both original pronouncements and in the codification is essential. It's essential for us to accurately identify project issues and to develop and amend requirements. Every standard setting project includes the development of codification content, and you must be able to determine the effects throughout the COD, which, depending on the complexity and the extent of the project issues, may be quite challenging and time-consuming. We develop and maintain information about the relationships between the original pronouncements and the codification, so we do that internally. We maintain information about those relationships, and that includes the sourcing process that we go through. So if you're looking in the codification and you see the source of each paragraph, we're maintaining all of that information and updating it as new standards are issued and existing standards are amended. And that sourcing process can be very time intensive and may require a certain level of judgment depending on the complexity and the topic. And the sourcing approach has often changed over time. So that's another piece of the puzzle. The dual authority structure requires ongoing maintenance. And so we make updates to status pages, and we also mark the original pronouncements in GARs as they are amended and superseded. So that shading and bars that you see, that's an ongoing maintenance activity that is specifically a result of the dual authority structure. All of those research activities and the results of phase one identified, in our view, certain challenges with the dual authority structure. And we believe that some of those potentially could be alleviated by a single authority structure. Specifically, some of those concerns and challenges were that heavy reliance on the standalone pronouncements. We note that could lead to a lack of awareness of changes to existing guidance or preparers or auditors using incomplete or superseded guidance if they're only relying on the standalone pronouncements. Again, many interviewees acknowledge the advantages of the codification and its comprehensive nature. The research told us that it's challenging to use any document by itself. We saw, again, that a lot of our stakeholders are using those in combination. And the fact that you have to use all those different sources potentially indicates that our literature is more cumbersome than it maybe otherwise could be. When we were thinking about what the research told us, we also gave consideration to our next generation of accountants. We want them to be able to understand our literature, and we need to be able to communicate the body of literature as a whole. And we believe that a GAAP structure can either help that or hinder that. And some of those challenges that were identified in phase one indicate that the dual authority structure potentially contributes to a more discrete or siloed view of our standards, which maybe obscures some relationships between requirements, between statements, between standards across our literature. Again, internally, maintaining those original pronouncements in COD both are time intensive and can be cumbersome, and it'll be only exacerbated as more and more standards are issued. And so all of these concerns or challenges led the board to approve the second phase of the research. And again, the objective of the second phase is to determine what a potential single authority structure would entail. So explore a single authority structure and whether it would be operable. So if we take a look at the phase two research timeline, and this is, I will note and caveat, this is a tentative timeline. This is based on the technical plan, but we began the phase two research activities in May of 2024, and we have been conducting those research activities. As part of phase two, a consultative group was established for this pre-agenda research, and we held working sessions with that consultative group between June and September of this year. we are currently working on the development of a discussion memorandum, and we anticipate or hope that the discussion memorandum will be authorized for issuance in Q2 of 2026 with a comment period through the end of Q3. And then after that, we'll analyze the respondent feedback. So I'm going to speak a little bit more about the phase 2 research activities, but this is the overview of the timeline. So again, phase 2 objective, determine what a single authority structure would entail and whether it is operable. The activities of phase 2 include reviewing the structures of other standard setters, developing alternatives for each component of a potential single authority structure, establishing the consultative group and conducting the working sessions, and then developing and issuing a due process document, which is a discussion memorandum, to gather feedback on a potential single authority structure. Okay. So I wanted to spend a little time talking about the working session topics that we discussed with our consultative group. So the working sessions were a research activity that we took on to inform the alternatives for the single authority structure that would then ultimately be presented in the discussion memorandum for broader stakeholder feedback. So we were starting with our consultative group to help us refine and develop the alternatives, and then those will ultimately end up in the discussion memorandum. We held 4 working sessions with our consultative group. And again, we are so thankful for our consultative group. We have some consultative group members here in the room. Thank you again for participating. We held 4 really productive working sessions. They were a roundtable style sessions where we asked for feedback on a variety of topics that you can see here on the slides. So we started with looking at the source of authoritative GAAP in a single authority structure. And what we mean by that is if you move to a single authority, what is the source? Is it the codification? Is it something else? And so that was really you have to have that answer to really be able to dive into the next pieces. So we spent a good part of working session 1 on that. And then we talked about if the single source is a codification, what does the content look like in that source? How would it be organized? And we talked at a high level how it would be organized. Would we keep sort of the current structure and organization of our current codification with the parts and the sections, or would we move to something more like FASB's codification, which is organized by assets and liabilities and element type focus? So we talked about that was sort of the high level, and then we went all the way down content organization into paragraph numbering and things at a much lower and detailed level. So we spent a good bit of time on content organization. In our 3rd working session, we talked about how we would communicate changes to GAAP in a single authority structure. Because right now, if you think about how we're communicating new standards, it is that original pronouncement. It is that statement. If you move to a single authority structure and the single source is the codification, how are you communicating changes to that? What does that look like? And so we spent all of working session 3 talking about that. That piece is really critical to a shift in structure and understanding what that would look like and how that would work. And then in our 4th working session, we talked about the role and placement of a basis for conclusions. In the first phase of the research, we really did hear from our stakeholders that the basis is critical. And we know that, and there's no intent to remove the basis, but it's talking about where does that sit? How does it fit? And so we spent our 4th working session on that topic. These sessions concluded at the end of August, and now we are working towards the development of a discussion memorandum. I'll say it's a little bit unique to have a due process document in the pre-agenda research phase of a project. It's not something that we've typically done, and I don't think we've issued a discussion memorandum since the 1990s, if I'm correct. So we'll have that forthcoming. But the purpose of this is to outline alternatives for a potential single authority structure. And the reason we want to do a due process document is to be able to seek broad stakeholder feedback on this shift. And so how this will work is we're hoping we'll outline the alternatives in this draft discussion memorandum. We'll obtain feedback on that actually before it's authorized for issuance. And so the way that the timing works out, it's at the beginning, I believe, of next year, Q1, and we'll obtain feedback from our consultative group members, from members of the GASAC, and from the board. And then a discussion memorandum is authorized for issuance. It is a neutral staff, intended to be a neutral staff document. So that is a characteristic of this due process document. And then once it's authorized for issuance, we'll seek respondent feedback. And what we hear from respondents will be then incorporated into the research memorandum and ultimately help to inform the recommendation that ends up in a project prospectus somewhere down the line. And so looking ahead, I'm calling, once we've issued the discussion memorandum and gotten the feedback, that's kind of the conclusion of phase 2. That will wrap up the phase 2 research activities. And that's happening about a year from now, December 2026. And then we will develop a research memorandum in the first quarter of 2027, present that to the board. And then at some point after that, there would be a project prospectus to, again, either recommend moving to a single authority structure, retain a dual authority structure, improve the existing structure. So those are the types of things that could ultimately be the outcome of this project. And now I'll open it up for any questions.
Thank you, Emily. Questions? Bob?
Scott, let me go first. Whoa. Emily, I'm trying to imagine if we go to a single authority structure, how the exposure draft and proposed standards would look like. Would it already be codified in? And then trying to imagine how I pick out what's changing. And so obviously FASB has gone that way. So could you answer a little bit on that?
Sure. I think there are some different alternatives, certainly some different alternatives that the consultative group discussed. One of the approaches is to issue a standalone document, an exposure draft that includes excerpts from the codification and shows the marked changes. And that's similar to FASB's approach. Certainly, if all of the standards that are being issued are new, for example, there's going to be new standards on leases, then it could say that, right? It doesn't have to be entirely underlined. The whole document doesn't have to be an underline. And so that's one alternative. I think there are some other options that we are considering sort of outside the standalone document structure, but those are the types of things that would be included in the discussion memorandum for feedback.
Confessions of a rehabilitated statement person. GASB 68 cured me of statements because there were so many follow-up statements. You just lost complete track trying to do it statement by statement. And so ever since then, I've relied on the codification.
Scott?
Thanks. Scott Deviney, AGA. AGA has long advocated for a single authority structure. Specifically, we're like, Go FASB ASC. So obviously I'm a super fan of this project and just wanted to again express strong support for it. Not only for, I think, many of the benefits that it has to standard setting, but especially just for that next generation of learners. Even some of the comments that I was sharing today, where I think it has an implication for standard setting, like with the footnotes or with glossary terms. That's all about like when not for us, not for this group, not for insiders, but when there's someone new that wants to learn about a topic 5 years from now and they go to GARS, can they search for it effectively? Can they find it? Can they look in the glossary finder or do whatever and get to the right information without getting sidetracked? So anyway, just super positive about this, and yeah, I'm cheering.
Dean?
Dean Mead, NFMA. Happy to follow you on that, Scott, because boo FASB ASC. I'm an intensive GARS user. I love the codification. And I'm one of those people who, when you've got a new pronouncement and it isn't something that is, intricately interwoven into existing standards, the statement works during the period of implementation, and then going forward, you want to make sure you're looking at whatever the current text is in the codification. But I think the organization of GASB's codification is vastly superior to the ASC, and I would not want to see GASB move toward the way that they organize their codification. And these are my opinions, because I doubt I could get most of the members of NFMA to comment on standards that they don't tend to look at. And the ASUs, I think, are even worse. I find them very difficult to interpret and to understand what's happened. Now, if you want to ensure me of a future stream of revenue when I offer my services to clients to explain to them what this new GASB ASU is going to require them to do, then sure, go right ahead. But I don't think it's going to encourage or them to read the standards themselves and to understand them and to utilize them, whether it's a single or a dual authority structure. So I just wanted to put out there that not everybody thinks the FASB codification is great. And just if everybody isn't aware, they're latecomers to the codification. GASB had a codification in '84. I don't remember the date when they first introduced the ASC and started moving to ASUs, but GASB had a codification well before they did.
Any other comments for Emily and Ryan? Seeing none, just want to say thank you so much for the project. Thank you for the update and appreciate the good work that's going on, and looking forward to hearing more about it.
Thanks, Rob. We should have something, if everything goes according to plan, for the members of this group at the next meeting. So hopefully this provided some context for that when it comes to you.
All right, so we are a little ahead of schedule, so we're going to tweak something really, moving something forward, which is Alan's going to give his update that was scheduled for tomorrow. It's now going to be this afternoon, so I'll turn over to Alan to give the update on the report for the Director of Research and Technical Activities.
Thank you, Robin. I appreciate that. Two things. You're about to see how fast I can throw a report together, because I was going to put this together tonight. So we're okay with that. It's all good. It's all good, because the upside of that is I remember everything Joel said this morning, because one of the things I don't want to do is repeat what he said. So it's still on the top of my mind. So it's all good. I won't take too much of your time, because I know after we get out of this, then we'll have a little bit of a break, and then we'll have some social time and some dinner tonight, which I still think is going to stay on the original schedule. The schedule for that's not changing, because we couldn't do that at this point. So that will still be on the original schedule. I will say that welcome everybody. We're glad you're all here. You know, we don't come to this location very often, but every once in a while it's kind of nice to come to. It's a very unique building and a unique location in the city. And so it's every once in a while it's nice to just come out here and see it, right? And it's got some very unique stuff to it. And you should all know at least one movie you've seen done in this hotel. If you don't, go figure it out because it's not hard to figure out. Very famous one. A couple of things, and I'll just go through. I got half dozen, 8 things on this list that I was going to talk through real quick, and then let's start out with just technical inquiries. A couple of things on that front. It won't surprise you. You know, technical inquiries, it's interesting because you can see the topics they move over time, right? Some things stay there, and some things we do a lot of questions for. What you see is as a statement's getting implemented, it goes from sometimes not being on the radar at all, and all of a sudden it's the highest thing on the radar. And if you looked at this like 2 years ago, you'd have seen leases and speed is way up at the top. They're not anymore because guess what is? Compensated absences. It's now the one we're doing the most questions on. I will say the interesting thing about compensated absences to me is, and I think this would be fair, and if Deborah was here, she'd probably agree with me on this. A lot of compensated absences are facts and circumstances unique to government type questions. And they're about their leave types and their leave plans. Sometimes for some governments, it's the number of leave plans they have. This might surprise some of y'all, but I had a conversation with the government the other day that they have 29 different types of leave. It's like, wow, that's a lot. And so they're going through that, and they're going through the work of that, and they're going through the assessment of that. So we're getting a lot of questions on, I have this scenario, I have that scenario, I have this unique scenario, and I have this, and we partially pay out here, and we have this cap for this, and we have this implementation here, and we have this date there. And so, you know, you saw a couple, we've called it an implementation guide question, and the last implementation guide was more about paragraph 17 and not having to project the salaries going forward. But the truth of the matter is a lot of our questions, we don't have more questions to answer for you because the ones we do answer for the TIs are so specific to that government. But we're answering a good bit of them. The one thing that we do mention, and the one thing that continues to come up in that, well, I'll get to it later. We still get Lisa's questions, not surprisingly. But the other thing I want to touch on is, it does worry me a little bit as sitting here in the director's seat. It does worry me a little bit. If I looked at the trends of the number of TIs we answer over a given period of time, they continue to go down. And that's been very true since COVID. And I can look at that in one of two ways. And I can say, well, we're not doing pensions anymore. We're not doing OPEB anymore. We're not doing fiduciary, some of these other products anymore. Well, and that's why they're going down. I could also look at it and worry that people just don't know to call and they're not asking. And if they don't know to call and they're not asking, then we don't know they have questions and we don't know how to answer we don't know how to help them in answering the questions. And then therefore, we also don't know there's things that we could actually help improve and help provide clarity on. So I say that to y'all, not hopefully everybody in this room would know that we answer TIs routinely, would call us when you have a question. But I also say to y'all just to make sure you take back to your groups and remind them that we have a technical inquiry process. And we take a lot of pride in that process, and we take a lot of pride in answering those questions. And if people just don't know, I think part of it's turnover. I think the folks that have been around for a long time knew to call. I think some of the folks that might be newer to government don't know to call. And therefore, they don't know that we'll answer those questions. And the staff, I don't know if I'd say they enjoy answering the questions, but they take pride in answering the question. It's nice to help somebody. It's nice to help answer a question, help explain to them something. So I don't want to worry, but I worry that the volume's going down when really there's questions that we need to be answering that we're not getting the phone call. So just remind folks that we do want to do that. I'm going to touch on one topic that we're not going to get to it all today, and there's no standard questions out there today, but it's a question that we get a lot in GASB updates, and it's related to Statement 102. And it's actually a Statement 102 and the one big beautiful bill. Because it's funny, when we did Statement 102, it would look like we were very prophetic and when we did this, but we weren't, but it applies. Folks have asked us, could the one big beautiful bill cause a 102 disclosure? And the simple answer is, yeah, it could. There's a lot of judgment in that. I think that when we looked at 102, we thought about governments and we built it on these 3 criteria: that you had a concentration constraint. Most people knew what those were. You had to have a substantial impact. Most people realized that was a really big deal. It wasn't something that was just material, it was substantial. But you had to have an event, right? And in most cases, you might have a concentration constraint, like a single employer or a cap on your property tax. You have that all the time, and you know the impact would be really big if it ever happened, but you have no event causing it to be a problem. Like your major employer is not leaving. So you knew the distinction of whether or not you were going to have a disclosure probably hinged on that event. And then the bill came along, and they started talking about cuts, for lack of a better word, to federal grants, right? most of us in this room and most governments probably have a concentration related to federal grant revenue. And if they lost that federal grant revenue, that impact could be substantial. But you probably never thought you were having an event where all of a sudden that federal grant revenue was going to go away, right? And all of a sudden the big beautiful bill you do, which shifts the focus from do you or do you not have an event? Because I think the answer would be yes, to how big is the impact? And so now the judgment becomes not whether it's an event or not. Now the judgment becomes whether or not that impact is going to be substantial. And that's the part that me nor Joel nor any of the board members can tell you whether what that threshold is. But it is something that either y'all are thinking about or some of your governments might be thinking about is, could the result of the one big beautiful bill cause, that event cause a concentration or a constraint to have a substantial impact? As I've talked about with Rob before at Oregon, where they have a conforming statute related to income tax, when all the Trump tax cuts went into effect and became permanent, Oregon looked at that and said, uh-oh, because that had a trickle-down effect to Oregon's, personal income tax in their state. And so they have to have done that assessment. I know Rob's been working on that. So I bring that up to just say that there's a world in which, that bill is an event and could result in impact. Well, it could result in an impact. Whether that impact is substantial or not, that's obviously a judgment for a lot of folks to deal with and figure out. And that's not something that we can tell you, yes, it does, or yes, it doesn't. But it does. We hear this a lot of that, at least about that question. Couple other things that are on our agenda that I don't think Joel talked about, and he might have touched on a little bit, but I don't think he talked about. Digital assets, we continue to monitor that, but I think in our world right now, and I think you mentioned digital assets in passing, but we still stay in this place where we don't really think there's anything for us to do right now at this moment, because we still think if it's investment, fine, you've got investment literature you can look at, you fair value your investments. If it's not, it was really going to be about the collection or the ability for taxpayers to pay their property tax bill with some kind of cryptocurrency typically. But as far as we know, and you know something else, tell us, as far as we know, in almost every case, they've got a third party in the middle. And so the taxpayer pays a third party, the third party converts it to US dollars, and the government gets the US dollars, which is equal to what they billed. So from the government standpoint, they got their $1,000 tax bill. Obviously, that third party has taken the translation risk of translating that cryptocurrency to whatever they want to translate it to. There must be some money being made on that because they're in that business, and that's fine. But it's meant that we didn't really have to do anything from a standard setting perspective. We still think that's true. We still think that's where the case is. We haven't talked about needing to do anything with digital assets, even though we monitor it. Even when the state started talking about strategic Bitcoin reserves, what was that? And for a lot of cases, that turned into the Treasury can just invest some of the Treasury funds into Bitcoin. We can argue whether that's a good idea or not, but investing some of their liquid funds into Bitcoin is still an investment. So we've still got guidance on that as well. So we haven't really thought the need to do that. One of the other monitoring activities you'll see on our list is the impact of technology on governments. And so when we decided to take voluntary digital financial reporting off and put it actually in the tech plan, which you'll see, and we'll talk about that tomorrow, we replaced it with something called impact of technology on governments. And it was funny because when we did it, I don't know that we necessarily thought about this, but it's very true. We were thinking about things like AI and what does it do to governments? How is it going to affect governments' financial reporting? Now, are we going to try to solve what a government should do as it relates to AI? No. But do we need to understand how that affects their processes and how that affects how they go about business and how that affects financial reporting? I think folks think we do need to understand that. That monitoring product is just so we have a sense of what's going on in that space. AI is one of those topics. I don't know about the rest of y'all, but I don't know that I go a single day when someone doesn't ask us about AI and how it affects governments, how it affects financial reporting, how it affects, actually sometimes we get asked how it's going to affect standard setting. And so understanding just AI and what it is, some folks might look at AI and say, well, that's just the new evolution in technology. We had ERPs, and then we had robotic process engineering, we had bots, we had automation, we had all these things, and AI seems to be the next evolution. The internet, it's the next evolution in technology. And so how does that affect governments, especially from a financial reporting standpoint? We tend to pay attention to that or want to pay attention to that. The other thing we continue to pay attention to and continue to talk about is materiality. It is something that gets a lot of conversation. We think that's something that we've been talking to folks about. Somebody mentioned this morning, I forget who it was, mentioned in the box, the provision of the statement need not be applied to immaterial items. It's in every standard. I know tangentially in conversation with folks, whether it be about leases or speeders or also GASB 101 is another great example of it, that folks don't always, I ask them, when we issue a new standard, what do you think about? Well, the first thing is, do we have those transactions? great first question. A lot of governments, for the next question they ask is, well, how do I do the math? I'm like, well, your second question should have been, is it material? And then decide how to do the math. And I think a lot of people skip over that second question. It's very relevant, related to leases, related to speedas, related to compensated absences. It's actually related to every standard. But just making governments aware of that and aware of the idea of it. Because one thing we continue to hear, and Joel and I hear this almost everywhere we go, is governments will tell you they still don't have enough resources, and they will still tell you they have too much work to do. Right? And maybe materiality is one small way where they can decide there's a little less work to do in a particular, related to a particular transaction, because maybe those transactions aren't material. So we continue to talk about that. You're never going to hear us talk about, you're never going to hear anybody within the building, me or Joel or anybody else, say what that means in terms of a number or percentage or an idea like that. That is not a conversation that you should ever hear us say. So don't worry, because I can't tell you what percent of what balance it's going to make something material. It's the idea that materiality is a concept. Joel did mention the IG. I will say that we are focusing on subsidies. We are focusing on 1 and 3 in subsidies. If you're in the healthcare space or the higher ed space, or in Abel's case, you're in the transportation space, you might see some of those questions that are very relevant to your world and your space, because if you think about it, 103 in subsidies is all about proprietary funds. And then if you really think about it, there's certain industries that they're really into proprietary funds, and those 3 industries being the 3 that come to mind, there's questions related to those 3 industries in the potential question list. The last thing I guess I would mention is probably my way of saying thank you. I would say thank you on behalf of everybody today, but the conversations that we can have, especially the one we're having this morning related to RER, is extremely helpful to us. I know sometimes that those papers, those are very complex topics and complex ideas, but this is how we figure out, are we thinking about it the way we need to think about it? And are we explaining it in the way we need to explain it? And do the thoughts start to resonate? You know, the whole conversation today when people started cluing into the estimation conversation was fantastic, because that is a fundamental thing within measurement, within RER. And for folks to like clue into that and start asking questions about that means, okay, maybe that's just because we were in the TWA building today. Maybe it was because of the PowerPoints. That was something we did on purpose with the PowerPoints for that product, to give you that, because I do think the PowerPoints visually maybe let you think about it a little more than having to read all the words, even though the words are still important and the words are still what's going to be in the standard. Maybe it allowed for the discussion. But I just want to say thank you on behalf of all of them for that conversation, because that's why these meetings with y'all are important, is we can hear what y'all say and what y'all are thinking if we didn't get the words right. That is everything on this list. So Rob, unless there's questions, I think I'm done.
Thank you, Alan. Any questions for Alan? Dean?
Thank you, Alan. Joel had mentioned this morning that nothing was added to the technical plan when the board adopted the final third plan, but some pretty significant changes were made to the revenue and expense recognition project. Went from an exposure draft that would have been issued this month and a final statement in June of 2027 to 2 separate exposure drafts, the first of which won't happen for another 1.5 years or so. So I was wondering if you could say something about the nature of those changes and why they were made.
I think the changes to RER specifically was related to the fact of, as we're having this morning, it's a very complex and very complicated project, and we need to get through it, and we need to make sure we get both the TBDs and deliberations on both Category A and Category B right. But then more importantly, I think there's an understanding that the document itself is gonna be comprehensive. That's not the best word. Complex is probably a better word. And more importantly, when you start thinking about the number of illustrations that we probably really do need in order for people to really understand some of the topics that are going to be in there, whether it be unit of account or binary arrangement or categorization or transfer control for Cat A, whatever it might be, right? I won't quote the exact number of illustrations, but it's a lot of illustrations, and part of that's just to make sure we provide all that context. And so part of the change in the timeline was to make sure we give everybody enough time, to give the staff enough time to get the words right for the standard section and get the words right for the basis. As you can probably imagine, Dean, as you know, the codification instructions will not be simple in this conversation either. They're going to be intense. And you know that. And we're planning on doing a large number of, and I don't want anybody to quote the number, but we're planning on doing a large number of illustrations. And we also appreciate there's going to be a lot of conversations and education and just talking to people about what this actually means. I mean, we got a little bit, Dean, we got a little bit of insight in today, talking about what we were talking about with measurement, and the words weren't even on the page yet about what measurement are going to be. So I think there's an acknowledgement that it's a pretty big project. We say this all the time, Dean, you know this. We say this all the time that, you know, when FASB took on Topic 606, it was revenue recognition. We're doing revenue and expense recognition, and so it's a pretty big thing. So I think, Dean, what we wanted to do was, when we thought the time was right, which was this update, and I appreciate you noting it. We knew this was coming. We knew the change was coming for a while, because obviously, as you noted, the exposure draft isn't this meeting. But we also didn't want to do it before we had a pretty good sense of how long it was going to take to actually get it to the right place. So when we make the change on the time, we could make it once. And that's what we were actually attempting to do. And so you're right, it did push some of those deadlines out. But I think that's a more realistic idea of when we will have it ready. So I hope that answered the question.
It did. Thank you. And if you push it, it may be far enough now that the authority structure will leap ahead of it, and then maybe you don't have to worry so much about the codification.
We didn't do it for that reason, but that might be true. That might be true. But I appreciate that, and I appreciate the question. Anything else?
Other questions or comments for Alan? Sophia?
Thanks, Sophia DeCaro with NGA. I don't know about everybody else, but after each staff person presented, I felt like I wanted to clap, but I didn't, because it would have been awkward. So I just think everyone did a really great job, and I was super impressed, and I would love to clap for them.
I know there's a lot of time, effort, and work that goes into these papers, Sophia, and there's also a lot of desire on the staff's part to make sure they do it in a way where they give y'all the ability to comment, because that's really important, getting y'all's feedback. And so I know they'll appreciate that. And so thank you.
Any other feedback? I know that's a tough thing to follow, but certainly well said. So thank you for bringing that up. All right. So it is 4 o'clock, a little bit after 4 o'clock. Our next item on the agenda is a 5:30 social hour. So I just wanted to flag for folks, it's going to begin at the 1962 ballroom, which is located on the far end of the lobby to the left of the desk where you checked in. So 4th floor, keep going left where you checked in, is 1962 ballroom, 5:30 social hour. So please join us. Looking forward to it. And we'll see you then. Thanks everyone for a great day. And we'll tomorrow. Oh, before I forget, our new FAF Executive Director, Erin Hill, will be joining us for dinner. So please do say hello to her and introduce yourself. She'll be sharing the FAF update tomorrow, but we're grateful to have her joining us for dinner. So please say hello to her and introduce. All right. See everyone then.